Ladies and gentlemen, distinguished guests, welcome to the annual OeNB Economics Conference together with the SUERF Colloquium. It's a great pleasure welcoming you here. You will ask, that's a new conference venue you have selected. Yes, we did. This is the Imperial Stable, as you may know. As you can find out, it's a very functional surrounding there, but I hope to give you incentives to join us also next year, because by then our Imperial Kassensaal will be refurbished, fully translated into most modern electronics, and hopefully a little bit back from the Imperial Stable into the Imperial Kassensaal. So please come back next year. Thank you for joining us, both virtual and in person, and I would like to extend my sincere gratitude for those who came to join us physically here, and as it happens, more and more electronically. This year's celebration, this year's conference constitutes also a double celebration, because it's 50 years of the OeNB Annual Economic Conference. Yes, it's already 50 years ago. And it is 60 years of SUERF. So a double anniversary we celebrate today. And it also shows the long-standing great cooperation between OeNB and SUERF. When it comes to the topic of this year's conference, I start to believe that we have prophetic capacities at the OeNB SUERF annual conferences, because last year we thought it wise that we should have a title which talks about the return of inflation. And as you recall, when we sent the invitation, we had an interrogation sign, but when we had the conference, we had to exchange against a big exclamation sign. And this year's conference is dealing with the question of how stable is our monetary economic system. And so we want to look into questions of stability, robustness, and resilience, and only to experience soon afterwards something which showed how important this question is. So I may ask my colleagues next time to come up with a positive title, and hope that the same holds, that we will have a positive outcome then. Thank you. Now, hence, on a more serious note, it seems obvious that a conference discussion of robustness and resilience in policymakers require a clear definition of these two terms as a starting point. As session 3 tomorrow afternoon will emphasize, careful definitions and wordings can make a huge difference when it comes to communicating our policies. This is something that we have all collectively or individually experienced. Hence, how would I define robustness and resilience? To me, robustness presents the ability to withstand shocks or changing conditions, all while remaining fully functional. In other words, I would call a policy robust if it continues to work well in the presence of shocks or under different conditions. To give a concrete examples, a negative example, one could argue that conventional monetary policy did not prove robust to changing conditions. Both temporary impairments to the transmission mechanism as well as as other circumstances significantly reduced the mechanism in the euro area, and the ability of conventional policy to achieve the price stability goal during the last decade. Note that a robust policy can be quite different from a resilient policy, deriving from the Latin word resiliere, which means bounce back or rebound. I think of resilience as the ability to return to a stable equilibrium after a shock has caused dislocation. For this reason, I think resilient policies as policies that safely guide the system for which they were designed back to the pre-shock equilibrium. This definition does not suggest that conventional monetary policy was not always robust during the last decade. It was not fully resilient either. In the face of binding effective lower bound, conventional monetary policy alone would have likely proved incapable of steering the euro area out of the looming deflationary spirals and back to its pre-equilibrium equilibrium. Surely, these definitions raise several important questions. First and foremost, is there a trade-off between robustness and resilience of policies? Second, how do robustness and resilience relate to optimal policymaking? Third, turning to robustness and resilience separately, who determines whether a given policy has effectively remained functional in the presence of a shock? When it comes to devising resilient policy, does resilience require a bounce back to the pre-shock equilibrium within a given point of time? And finally, and perhaps most fundamentally, what are shocks in the sense of the definitions mentioned above? All these questions are non-trivial, and I'm looking forward to the opening keynote speech we hear soon afterwards, and session 1 shedding some light of the question of resilience and robustness. Moving on from the normative to positive questions, where do we stand when it comes to the balance between robustness and resilience in modern policymaking? I used the Google Ngram viewer to plot the frequency. I hope it works now. Yes. The frequency of two terms together, robustness and resilience, in a corpus of work between 1945 and 2019. And while the results need to be interpreted, of course, as always with caution, the graph shows quite clearly that while robustness had somewhat flattened out, resilience are still very, very high up there. And this is for English literature. If I go on, I think you have the second as well. Here you have it for German books and literature for the same time horizon, with little bit of difference around 2010, but otherwise it shows the same thing. So robustness has lost in importance, and the notion of resilience has become critical in the use. Now, I would like to pause for a moment and to reflect on what a potential trend towards resilience, when extended beyond the worlds of books, could mean for the design of policy. Would such a trend be unambiguously positive? High resilience implies a full return to the pre-shock equilibrium. Although this sounds like an unconditionally desirable feature, not everything about it may be rosy. Most importantly, successful return to a prior equilibrium point out alone does not guarantee to the source of instability or the risk characterized the pre-shock equilibrium are sufficiently resolved. So the concept of resilience has a bitter aftertaste. It begs the question of whether the policy system should merely aspire to become resilient to a shock, or whether it should seek to adapt, to transform, to preempt shocks in the first place. Let me illustrate this point with another concrete example. So-called unconventional monetary policy may have partially enhanced the resilience of the euro system to large recessionary shocks and impairment of transition mechanism. Yet, these policies do not address the underlying weaknesses that caused the predicament for our conventional tools in the first place. OeNB, unconventional monetary policy, per se does not reduce the future probability of hitting the effective lower bound, nor can it place sustained capital market integration in the medium term to long term. To resolve these problems, we need to go beyond mere resilience and open discuss new remedies such as asymmetric reaction function, make-up strategies, structural policies to raise the equilibrium real rate of interest R*, and related measures that foster a true capital market union. We look forward to the discussions about the potential ramifications for prices, expectations, monetary or fiscal policy during the excellent academic and policy sessions on the topic tomorrow. Therefore, and to provide a little teaser for the discussion on the high-level panel of this afternoon, I will focus on the built force of resilience in the context of financial stability policies. It is widely known that well-intentioned policy responses to financial turmoil can be hotbed for future financial stability risks. Lending of last resort serves as a prominent example. It is frequently associated with the notion of moral hazard. Anticipating central bank support, counterparties have an incentive to downsize their holdings of non-interest-bearing liquidity assets. This behavior can diminish the financial system's ability to cope with the future systemic shock or contagion. Hence, lenders of last resort is a case in point for a policy that makes the financial system more resilient, but does not necessarily address the underlying weaknesses, generating the vulnerability to regular shocks. Worse still, due to its moral hazard implications, a functional lender of last resort can even compound these vulnerabilities. Today, stringent liquidity and capital standards for banks are our first line of defense against moral hazards behavior. In addition to binding regulations, two other elements are key. First, stress tests that subject banks to adverse scenarios and analyzes their capacity to withstand future yet unseen shocks. Second, actionable resolution and restructuring plans for inviable banks are crucial to credibly check bailout experience in case of insolvency and forestall too big to fall standards. Regulation, stress tests, and orderly resolution belong to the realm of robustness enhancing rather than resilience enhancing measure. While not necessarily returning the financial system to the pre-shock status quo, these policies are designed to allow the system to remain functional in the presence of previously unknown shock when an individual bank gets hit hard by idiosyncratic risk and fails. How are we doing on the robustness front when it comes to safeguarding financial stability? To be frank, the evidence is at best mixed. The effectiveness of prudential regulation has long been questioned on the basis of incentive problems. Some have even argued that higher safety buffers are not empirically associated with lower odds of banking rising in the long run. While stress tests have helped to gauge the extent of exposure to future risk, such as climate change, we sometimes miss obviously short-term developments. Recent evidence suggests that the US stress tests failed to encompass scenarios that eventually led to the demise of Silicon Valley Bank, pronounced and fast interest rate hikes. They were simply forgotten. Finally, the handling of Credit Suisse suggests that the resolution plans remain incomplete and the authorities are hesitant to implement them in practice. These are topics we will take up in the panel, in the after next panel. To conclude, let me stress that even recent events elsewhere leave absolutely no room for schadenfreude nor for complacency in the euro area. We need to make sure now that our tools are fully functional rather than mere paper tigers. In order to be robust and resilient, policies must preclude any inability and unwillingness on the part of the policymakers to use the full arsenal of tools when push comes to shove. Reneging on such policies would only fuel moral hazards. Thank you for your attention, and I'm looking forward to addressing some of this issue with you in the next 2 days. Thank you.
Thank you very much. I was hoping that some slide would show up now, but should I do it myself? Oh, that goes too fast. Yeah, that's the one. Good. Thank you very much for attending. Let me also, on behalf of SUERF, the European Money and Finance Forum, say a few words. First of all, welcoming you, of course, but then also pointing out that SUERF, because not all of you may be familiar with SUERF, what we are doing. Here you can read our main mission, and the mission, briefly summarized, is to exchange views. Views among constituencies that, unfortunately, frequently do not talk to one another, namely policy-making institutions, financial institutions, and academics. And I think this exchange of views is very, very important for all parties. For policymakers to get new insights from academia, for institutions to get a clear view as to what policymakers expect from them, and also, again, what they can learn from academic research. And of course, for academia as well, because unfortunately, and I can say that as an academic, quite a few academic research is rather ivory tower research, so defunct from any usefulness. To get useful research for policymakers, for financial institutions alike, it's important that academics listen to the problems that policymakers face and that financial institutions face. So therefore, I think that it's key to have SUERF. And I'm very proud that SUERF is almost as old as I am. I'm not going to say how old I am. And I'm even more proud to say that we, especially since the COVID pandemic, have been extremely successful. During the COVID pandemic, of course, it turned out to be extremely difficult, if not totally impossible, to do what we normally did, namely to organize events, preferably with our member organizations. But we quickly adapted. We adapted by initially going entirely virtual, and also by creating policy notes and policy briefs. I still remember the discussion we had in our board about this proposal, and I think, with the benefit of hindsight, this was one of the best decisions we ever took. Below in this slide, you can see some of the numbers referring to 2022. We had, in total, 276 policy notes and briefs, written by a total of 672 authors. And of course, that's the supply. More important from our perspective is demand. Well, as you can see, we had more than 500,000 of downloads. That's quite a bit, especially if you realize that we only started a few years ago with this initiative. So I think this illustrates that SUERF serves a purpose. And I'm very happy, let me see whether I can do this. Yes, I'm very happy that many organizations are part of SUERF. Here you can see all our member organizations. And if you miss the logo of your organization, you know what to do. Contact the SUERF Secretariat. Membership of SUERF is extremely cheap, even for today's standards. It's 2,500 euros a year. So it's basically almost for free. So if you're not a member, please join the family of members and become part of SUERF. As I said before, we are also celebrating our anniversary, like OeNB. The slide on the left shows you the beginning of SUERF. And in that existence of SUERF, our collaboration with the Austrian Central Bank, the OeNB, plays a very important role. We have a long-standing collaboration with OeNB, and I'm very happy with that. So not only the governor shown here, but also his successor and also the current governor turn out to be staunch supporters of SUERF. And I'm very, very grateful to that, especially now that the SUERF Secretariat is also located at the Austrian National Central Bank, which is key to our success, I dare to say. So, Robert, thanks a lot for supporting SUERF all these years. Having said that, I think it's time to wish you all a very good conference. And I think I've been speaking too long, so let me use my last 2 minutes to introduce the next, or the first, actually, keynote speaker that we have. So can you please go back to the main slides? The first keynote speaker is someone I think hardly need to introduce, but still, I'm going to do it. That's Markus Brunnermeier. And Markus Brunnermeier is professor in economics at Princeton University and also director of Princeton's Bentham Center for Finance. And his research activities really are very hard to define because he focuses on so many different topics, including international financial markets, monetary theory, macroeconomics, with a special emphasis there on bubbles, liquidity, financial crisis, and digital money. Brunnermeier is also president-elect of the American Finance Association, and he got his PhD degree from the London School of Economics. He has been awarded several Best Paper prizes and also served on many editorial boards of leading economics and finance journals. And also, he has been advisor to quite a few policy institutions. So I think Markus is by far the best keynote speaker you can imagine, especially given the theme of this conference. So I'm very happy that he's talking to us about robustness and resilience in an uncertain and complex world, implications for monetary policy. Markus, I hope you can hear us, and the floor is yours.
Okay, thanks a lot for having me. It's a pleasure to be here, and I wished I could be in Vienna. I always like to be in Vienna. Sorry for coming only virtually. I would like to talk about resilience and robustness, and also in context of monetary policy, as you know, the Governor Robert Holzmann pointed out already. I will try to continue his thinking in these lines, and also congratulations for all the anniversaries for the OeNB and also for the SUERF. And thanks for inviting me. It's a pleasure to be with you, at least virtually. So, if you think about monetary policy, there's a big way of thinking either in terms of risk, and we have often a risk management approach where we say, okay, we take the probability of various scenarios into account, but also how bad these scenarios will be. So what are the contingency events? And it could be that it might be not so likely, but if it were to happen, it has a huge impact. And this way, that's what we often do in terms of monetary policy and other risk management as well. Here, I also would like to emphasize a little bit the ability to bounce back. That's a resilience approach. And what's really important is, and that you see already where a monetary policy shines through, bouncing back, once you have a higher inflation, you have to come back to the inflation target. So the inflation target has to bounce back to its original level of 2%. And what this immediately calls for is to have a strong anchor. And so the anchor and inflation targeting is closely related to the concept of resilience. The other thing which is closely related to resilience in context of monetary policy is to avoid traps. And I will outline various traps later on, just to see, once you're trapped, you cannot bounce back. And even worse, if you are more than trapped, if everything spirals out of control, then it's not resilient. And so resilience is very tightly linked to general monetary policy. And I will also touch upon robustness and will draw a distinction between resilience and robustness as well. So let me start first with the first half of the talk. I would like to talk a little bit about resilience in an abstract concept. And then I go later, I will focus much more on monetary policy and the connections of resilience and robustness in monetary policy. So resilience and risk, as I mentioned, so risk essentially means if there's a shock, you can avoid the shock or you can reduce the impact of the shock. So that's essentially what you can see here. So this is a normal way to go, but 10% probability you go down here. You can reduce it to potentially to 1%, that's reducing risk, or you can reduce the impact of the shock. Resilience, so it's a static thing. So you will measure this with variance, volatility, and so forth. If it's a system with a spillovers, you measure it with COVAR and so forth. Resilience means more dynamic, is that you cannot really avoid the shock, but you can bounce back later on. So it's much more about mean reversion concept rather than a variance or standard deviation concept or value at risk concept. And it's much more dynamic, it's over time. And often what you see could be that inflation is actually going up and you have to bring it back down. So that's it's a resilient inflation anchor. So a resilient path, if you think about it, you can think of, many different, in the abstract, you have a shock, it goes down and then it goes back up and you go back to the old average path here, which is the dotted line. And then you have another shock, it goes back up and down. You can think of as a GDP, for example, you can think of a portfolio behaving this way, but you can also think in terms of inflation rate. So this dashed line would be then the average inflation rate. So here the inflation rate, one way to put this is actually is very low, and then is above average. So on average, it will be the dashed line. So you can also flip it around. It could be very high inflation rate and always coming back to the 2% anchor. Avoiding risk is essentially, you can go for very aggressive policy where saying, we don't have any, downturns at all and coming back. So we have a very straight line like this dashed line. But what you can see, if you go for this dashed line in the long run, you would be better off by going the more risky route. As long as you bounce back, the more risky route in the long run is actually a better route to be. So avoiding risk at a huge cost and giving up some average growth rate, for example, in the economy, because you don't go for trial and error processes, you don't experiment, is actually not a positive thing to have. So that's the first thing about this was a contrasting risk and resilience. And then the second thing is, and that's what the Governor Robert Holzmann did as well, is what's the difference between robustness and resilience? So one, risk, avoiding risk and resilience, and the second thing is robustness. And for that, it's useful to think about robustness like withstanding the things. So you block off most of the shocks, and resilience, you might not be able to block it off, so you have a huge impact of the shock, but you bounce back possibly to a new normal. There might be even uber resilience where you actually bounce back to something even better. And I would like to put it in the perspective of La Fontaine, who was a fable writer in the 17th century France, and it also goes back to the old Greek tradition, where they contrast the oak and the reed, or the willow. In a sense, the oak, when the wind comes, is very rigid and stands in the wind and doesn't move at all, while the reed is constantly bouncing back and forth. So the reed is bouncing back and forth. And what happens then when a hurricane comes, actually the oak is pushed over to the tipping point in the robustness barrier. So the oak is robust So it doesn't move at all. It stands and withstands any shocks. But if the shock is really high, like a hurricane, a strong hurricane, it falls over. And in this story by La Fontaine, the oak and the reed, they talk to each other, and the oak essentially is very majestically and very proud of itself that it can stand so long. Look how strong I am, and you're weak you are, you're constantly bouncing back and forth with any little wind. But at the end of the day, when a hurricane comes, the oak falls over and can't get up anymore, while the reed is actually getting back up again, it's bouncing back again. And then the reed says to the oak, I bend and I bow, but I do not break. So I want to say that actually what happens is that the robustness is much harder to defend, that you don't move on. You're very rigid, while the reed is very flexible. And there's a robustness barrier, a tipping point when the oak drops over, and the tipping point, the resilience barrier for the reed is much, much more in the extreme. So it takes much a stronger hurricane for the reed to actually be unrooted in order to not coming back. And what is also related to this volatility paradox, where you say, you know, it looks like the reed is much more volatile, it's much weaker, but at the end of the day, it is a reed which is much more able to bounce back. And that's essentially this paradox. High volatility doesn't mean that you're weak. It might be also a strength. And this is also in the context of finance. You might say, if you have a system very much based on equity finance, it looks like everything is constantly moving, prices are moving around all the time. And then, but it's more resilient in a sense. Or if you put price cap on something, you might say, oh, I've created things more robust because prices don't move around. But actually what you have done, it made it weaker. And then, you know, once it breaks, it's harder to come back. So what I want to do, essentially, I want to contrast this resilience management. I want to outline what the resilience way of thinking about it and also going is what enhances resilience and what destroys resilience. And there are certain elements which make resilience better and certain elements which destroy resilience. And I might mention also briefly uber-resilience or uber-resilience, where essentially that's where you're shocked by a shock, you're hit and you bounce back, but you bounce back to a situation which is even better than it was before. Think about COVID. We have developed mRNA vaccines, and we bounce back to something even better because now with these new mRNA vaccines, we can also develop new methods for cancer treatments. We can develop some malaria vaccines and so forth based on the same technology. So actually we are better off after the shock. Of course, there are also a lot of negative long side effects. But let me first go to this resilience enhancers. And the key is that you want to be easy to adopt and strengthen the system and the resilience destroyers. Now, what are the resilience enhancers? And very obviously, these are buffers, redundancies and buffers. And this is also there for robustness as well. So what you have, if you have high equity capital buffers, so the banks should now, for example, not be allowed to pay out huge dividends or make stock repurchases. So if the ECB allows to make, you know, for UniCredit and others, to pay out huge equity and make stock repurchases and pays out huge dividends, I think that's very, you reduce buffers, and this makes the whole system much less resilient. And that's essentially something one should look out for, in particular here, and the whole macro-prudential measures come into place here as well. The redundancies between you need for robustness and for resilience are slightly different. For robustness, you need a redundancy for each shock because you have to immediately block it off, so you have to have it ready. While for resilience, you can have more flexible, fewer redundancies and flexibly employable. So the flexibility is very important. So you don't need a redundancy for each type of shock because you're hit by the shock, but then you can redeploy the redundancies in a flexible way and then bounce back. So you save on redundancies if you go from a resilience approach than a robustness approach. So the key in general for resilience is flexibility, liquidity, adaptability. So being nimble, being able to react in a clever way and setting things up that you can react to that. So rather than having in product design, you can have this, but in any policy design, you have a policy which gives you the correct reaction function and you react to that as well, such that you bounce back. And of course, often you need certain infrastructure and digital approaches, information flow, and other things which make it possible for you to react the right way. And that's essentially very important to keep the flexibility and the reaction in order to bounce back. Another resilience enhancer is diversity, and diversity you can see, if, for example, if you have a shock, if you have everybody is the same, then the shock is very much a systematic shock because it hits everybody the same way. If everybody is different, some are hit more, some are hit less, and you have much more idiosyncratic component of the shock. So here's just an analogy from biology. I have here a forest which is very homogeneous, and then there's another forest which is very heterogeneous. You can see if there's a certain bug coming, taking over and hitting the forest. If it's a very homogeneous forest, the whole forest will be gone. While this forest, which is a much more mixture of different types of trees, it might wipe out one type of tree, but then other trees will step in and the forest will be preserved. So what's the difference if you think about risk management and resilience management? In risk management, it's like you just don't put all the eggs in one basket because you don't know which one will be hit. And then if one is hit, you suffer only from one instead of all the others. The resilience is also, diversification is also an important feature for resilience. But what's really important is that if one part is hit, other parts can step in and you can scale up the parts which survive, and this way you bounce back. So this, again, this diversity combined with the flexibility that the parts which are not hit can actually step in and be scaled up, this actually makes a resilience. Now, the third thing you should, or the fourth thing you should keep in mind is that you should allow thinking outside of the box and, starting new things. And I can think of, when COVID hit, for example, SUERF actually started new initiatives. So he had some maverick thinking and doing new things, adjusting, thinking outside of the box and starting new initiatives help you. And that actually triggered, again, resilience to bounce back given the new circumstances, and actually helped to develop, online seminars and other things which are even better right now than compared to before COVID. Now, you can't have only mavericks, so you need a social cohesion. So you can keep people think outside of the box, but they all have to have the same aim, to push in the same direction. And then very importantly, and that's also what the governor was alluding to, you should allow smaller crises to learn from smaller crises. So you should not induce smaller crises, I'm not saying that, but preventing any crisis all the time at any cost makes you not resilient. So that makes you less resilient. And let me just show you this in this graph. So there's, of course, a dynamic trade-off. So what should you do with smaller crises? By being able to manage smaller crises, you're ready to have to manage also bigger crises. And you see it in economics. The emerging economies deal with smaller crises all the time, and hence they are very familiar how to deal with a financial crisis much more than the big economies. And that helps them as well. So here, for example, I have this old figure again where we have this resilient path. And you can say, okay, we put a lot of resources down, we avoid the first downturn, and then we avoid all the second downturn. But then you have used up, for example, all the buffers. So you use up the buffers only in the first and the second crisis, but in the third crisis, you have no buffers left. So even if you would have allowed this little crisis, learn from this, it would have helped you to come back to the old path in the third crisis. But because you now have never experienced any crisis, there was no learning effect, and you have used up all the buffers, you might actually fall down much further and might come back, but not back to the old path, the little dashed line over there. So in a sense, experience of smaller crises is an investment in future resilience. So one can view it this way. Of course, I'm not arguing that you should deliberately start a smaller crisis, but it doesn't mean you should actually throw everything at smaller crises, use up all the reserves in order to avoid them at any cost. But keep in mind, there is also some cost in the downturn. So, for example, if there's a crisis and you do huge unconventional monetary policy, you have to keep in mind it might make you also more vulnerable down there because you have used up all the reserves down the road. Now, these are resilience enhancers. So what are resilience destroyers? And I just mentioned three of them: traps, feedbacks, and tipping points. So if again have the same figure as before, where it comes back here again, you might actually be trapped, and then you can't bounce back. So if you have a trap, this horizontal line is a trap here. If you're trapped, then it's not a good idea not to go for this dashed line. You should go for the riskless line, because you grow up, if you go for this potentially resilient path, it's not resilient because you hit the trap and then you can't go back down. So traps is one thing to look out for. And I will mention in the context of monetary policy, a number of traps. We all know them, all liquidity traps, zero bound trap, and so forth. So the traps you have to really look out for. Now the traps are even worse if they come with feedback loops. So there's a shock, and then it feeds back, and then there's a second round shock, and third round shock is over a whole spiral, and things get worse and worse. So this essentially when you hit not only a trap or you're trapped and can't come back out, but you might also hit a tipping point when a feedback loop starts. So once you hit the tipping point, the feedback loop starts, and then actually the whole thing is going down even further. So that's essentially, really you have to watch out for that. That means it's not resilient. The system is not resilient at all. And in that circumstances, you can actually work to avoid such tipping points or avoid these feedback loops. But if you can't avoid them, you essentially have to go for the less risky path, because you don't have this option of this resilient path in that case. And then in many contexts, in particular in the climate change, thinking of, the Gulf Stream is turning off, you have essentially tipping points. And for this, you have to be very careful. You shouldn't take on any risk, because it creates troubles. Now, do I say you should, whenever there's a tipping point, you shouldn't take any risk? I'm not saying that, because seemingly sometimes going for the risky strategy might be the way to avoid a tipping point. And here it's one particular way to see where you escape the tipping point if you go for the resilience strategy. So here it's similar, it's just the growth rate, expected growth rate or the average growth rate is lower in all points. So here's my tipping point. And if you go for the riskless strategy, seemingly the riskless strategy, it goes downhill. Things are getting worse and worse and worse, and you hit the tipping point, and then it really goes downhill. On the other hand, if you go for more the risky strategy, but with resilience, you have a higher expected growth rate because of experimenting and taking on some risk, but resilient risk, you can actually grow away from the tipping point. And this way, it's not the case that whenever there's a tipping point, there is actually, you should avoid any risk. It could be that if you have clever, resilient risk with tipping points, that's the way to get away from tipping points. So that's the resilient path is the only hope in this example. It's a stylized example, it's very striking, but it's also sometimes in terms of monetary policy, you might want to take some risk, some controlled risk with some resilience, to knowing that this way allows me to stay away from certain tipping points. Now, the resilience destroyers is essentially, you can see this very clearly also in terms of GDP growth rate. So, and one big resilience destroyer is our financial crisis, so after bubbles. So when you have a regular recession, and you can see after a regular recession, it's always the economy is bouncing back to the old expected growth path. So most of the time, in particular for the US from 1950 till 2007, it was always the case that the US was coming back to its old growth path. What's most striking is the financial crisis, you don't come back to the old growth path, not in level and also not in terms of growth rates. Here it's very striking also for Japan. You have, whenever you have the Japanese banking crisis, for all the Japanese crises you have, it's coming down and it's not coming back to the old growth path. That's in this case, then you have this case, it's falling down, not coming back to the old projections. If the earthquake in Fukushima, that's when you bounce back, but typically there was no bounce back after financial crisis. So that's why one has to really watch out for this financial crisis and not let these bubbles develop in a financial crisis sense. And because these financial crises are not resilient at all. So that's essentially just what I wanted to say about avoiding risk on the one side might be actually more risky. So what you should think of, avoid risk if the risk comes with some resilience killers. But if the risk comes with resilience, so it's a temporary negative shock, but you can go back because you're agile and flexible, then actually you should take this risk because it enhances your average growth rate or the average possibility to grow. It might even be a way to grow away from the tipping point. So in terms of risk versus resilience, it's not obvious So you don't want to avoid risk. So the traditional way of viewing at risk management, risk is bad, and focus very much shutting down the risk. I would say it's different. It's actually, shut down the risk, which comes with no resilience. If risk comes with resilience, it's not so bad, so you can take the risk. So focus very much what type of risk you have, with resilience or without resilience. The second thing is, if you want robustness versus resilience, robustness is way more expensive to handle because you need for each shock a specific redundancies or buffers to really avoid it. So robustness is more expensive, so resilience might be the more attractive way to go. But sometimes when you have traps and all this, the robustness approach is the only alternative. Now, the next thing I would like to say briefly is that the resilience can be applied at different levels. It cannot be applied at the individual level. It can be applied by the system level and the society level. And you see, and each of them have slight different, and also matters a lot how society and the system is set up and is structured. So at the individual level, you very much have, personal well-being, mental health. So we have a lot of books written on the psychology and all this. So resilience, the term comes from material science. Of course, it's originally a Latin word, but it comes from material science. When you shock a metal or something, it bounces back to its initial status once the shock is removed. But, a system is also interesting. When is a system resilient? So you can think of, the interbank market as a system, the electric grid as a system, and you can also think of a global value chains as a system. And what makes a system more interesting, because there's some systemic risk due to spillover effects and domino effects. We know this very well from financial markets and regulating financial markets. The system is very much, pushed over to the spillovers, and you have these externalities and feedback. So this could be bank A or bank B. So the bank A does something, causes a negative externality on bank B. The bank B suffers from that and reacts to that, and that causes back a negative externality, a spill back to bank A. The bank A consequently reacts even further, and it causes further, and you get this spiral, these feedback effects due to externalities, and what I call this feedback externalities. So it's not only an externality, like a spillover is an externality, but if it's bundled with feedbacks, and in econ language, it's like strategic complementarities. So the other entity is reacting in a way which causes even more spillbacks and other spillover effects. Then actually what you get in these feedback externalities, which are due to endogenous responses. Now, what's interesting about a system can be resilient even though a subsystem is not resilient. Okay, so think about an economy. The whole economy is resilient even though part of this economy might go bankrupt all the time. And actually, it might be the whole economy is more resilient if you allow constant bankruptcy from certain firms. If you do bankruptcy protection, no firm can go bankrupt. Actually, the whole system in the long run the whole economy will be less resilient. So sometimes you can be more resilient by allowing subsystems to go down and replacing with other parts of it. So this ecosystem, which is moving around and breaking down, parts of it breaking down, might make the whole system more resilient. So that's a very important element to keep in mind. When systems are resilient, it doesn't mean that all individuals or all individual units in the system have to be resilient. And that's a big difference to a society being resilient. You cannot just say, okay, certain people, certain parts of society can go down in order to make others work better. So that's what I call difference in society resilience with regard, and this is the difference to systemic resilience, where the whole system is resilient, but it might be resilient because part of it goes down and is replaced with other systems. And we see this often in ecosystems going on. So the other aspect about systemic resilience is it depends very much how this network or the system is set up. So if you have a very centralized network, if you hit the center node, there's no resilience. But if you have a more different networks, decentralized, like this one in the middle, if some node goes down, then not the whole system is going down. And the most extreme, if you have a distributed network, like, all these cryptocurrencies and other systems, and also terrorist networks, they are much more resilient because once you hit one node, it's not bringing the whole system down. So that's the setup matters a lot, and how the network is set up, how resilient it is, and that's also how we should think of when we set up financial networks and so forth. Now, as I mentioned before, society being resilient, it's interaction among humans, and interaction among humans, you also have these externalities and these feedback loops and all these things. But it's more problematic in a sense, we cannot just say we let certain parts of society go down and replace it with new people. So that's, you have to have societal resilience, or implies individual resilience for all individuals rather than some inclusive approach rather than replacing it. The other thing is, of course, unlike in a computer electric grid system, it is very much driven also by expectations. So expectations make a big difference as well. Now, the final thing I want to say in the abstract, and then I go to the concrete about monetary policy, resilience is very important in transition phases. So when you have a shock, it's resilience, but you can also have a transition phase, which is a big, long-lasting structural change. And we see, and at the end of the talk, I will outline what are the transition phases. Because the one obvious one is a green transition we have to go through. And how fast do we go through depends how resilient we are. Okay, so there's a shock coming, and if it's a slow shock or a sequence of smaller shocks, for example, or is it a rapid jump shock? So you move at one big jump, and then the question is, are you resilient to that or not? Okay, so you have to have one way to run the economy now, and you have to have a different way of running the economy subsequently. Or think of, for example, when the Berlin Wall came down and all Eastern Europe had a strategy to switch to a more market economy, and there was often the shock and awe approach. And what is the optimal speed of transition? If it's too fast, then actually the system is not resilient, or society is not resilient. So you have to find the right speed at which you can make the change in order to keep it resilient. And what matters a lot is that what's the reaction time of leaning against a shock. So let's suppose there's a huge shock and you have to lean against it. And if the reaction time is fast, then shorter is better. But if the reaction itself leans against the shock, so the reaction is actually calms things down, brings things in the right direction, then you want people to react faster. But if the reaction, like in this negative feedback loops, is an amplification and it's these feedback loops, then actually you want to have slower reaction time. So the reaction time, the speed of the shock and the speed of the reaction time, when people react, how they react, you have to take this into account when you design at what speed you go. So in policy, we often think about sequencing. What sequence should we go? But in terms of these type of transitions, it's the transition speed we have to go, and then we have to make a judgment call between the speed of the shocks and also the speed of how people react. But most importantly, when they react, do people react in a particular which amplifies and makes things worse, or do they react and stabilizes things? And if they stabilize things, actually it's good if they can react quickly. If they amplify, it's actually bad if they react quickly. So now let me go to inflation or monetary policy more generally and resilience. And so let me make a bold statement saying the power of monetary policy is all about resilience. Okay, resilience is key in order to have any power in terms of monetary policy. So the ability to bounce back after the shock via the monetary stimulus, that's essentially how it goes. So imagine, for example, a setting, there's a shock and there's no resilience. And if there's no monetary policy, there's no resilience, then it has no power as well. So let me show that explicitly. So very easy, you can see this. It depends, resilience depends on the strength of inflation anchor. So if you have a credible inflation anchor, then again, through loose monetary policy, you can stimulate the economy because people believe you come back to the old inflation anchor. If there's no inflation anchor, there's nothing you can do. You can actually print money, but people will immediately react to that, and it will not be able to smooth. You will not be able to smooth out any shocks you might face in the society. So the credibility of the inflation anchor is essentially your resilience instrument, and that's what makes everything resilience. Of course, there's a resilience barrier. Remember, we had the oak, where there was a robustness barrier. If the hurricane is strong enough, it fall over and can't come back up. For resilience, there's also a resilience barrier. If the shock is too large or you don't have enough credibility, then actually the inflation anchor breaks and you cannot come back. And it's a little bit like a rubber band. So sorry, this should be a band rather than a bank. A rubber band, if you stretch it too much, it breaks, and then you can't come back. So there's no resilience. There's some resilience up to a certain size of the shock, and then you can actually come back, and this you can use monetary policy to mitigate the shock. And if you have a lot of credibility, you can mitigate then the shock. But if you push it too hard and the inflation anchor breaks, inflation expectations are unanchored, and new inflation is entrenched, then you lose essentially the power of monetary policy. Now that raises a question, what's an inflation anchor and how can we anchor inflation? And I have to admit that in economic theory, we don't have so much to offer here, but let me just say a few words about it, because it is really important to keep in mind that we really have to protect the inflation anchor in order to keep the power of monetary policy. And of course, everybody of you will probably knows this anyway, but what is an inflation anchor? An inflation anchor is that where everybody in the society agrees it's 2%. So it's like a convention, and it's common knowledge. So everybody knows that it's 2%, and I also know that the others know it, and the others know that I know it, and so forth. So all the higher order beliefs are coordinated around the 2%. And this immediately says, this is very hard to shift to a new level. You can't just say now it's 3%. You don't know whether the others have also understood it's now 3% or 5% or 4%. So moving an inflation target from 2% to some other level, like 4% or 3%, is not so easy, because it has to have a common understanding in society, and also higher order beliefs have to be coordinated. So there's a lot of uncertainty, not only what I think the inflation anchor would be if it's changed, but it's also uncertainty what the others believe, and the others believe of the others' beliefs, and you can actually make these higher beliefs go further and further. So there's uncertainty, and then there's disagreement. And it's more complicated even you can see it in the current context. When you have a wage increase, you don't know, is the wage increase just a compensation for past inflation? So trade unions would just want to make up for the past price increases, or is it already a reflection that they expect future price increases? Okay, this uncertainty makes it much harder to figure out what the others are thinking, and that's moving this inflation anchor is actually very difficult, and it's not so easy. It takes years to establish a new inflation anchor. So what strengthens an inflation anchor? It's strengthened if you have a clear focal point on the anchor. If commonly everybody says 2% is the case, and what's also strengthens the 2%, if there's no other focal point. So if we have everybody says 2%, and we know I cannot coordinate on 3 or 4% so easily, that strengthens the 2%, because then everybody says, we stick with 2%. And that actually strengthens the inflation anchor, and that actually makes monetary policy more powerful. So having no other focal point where we easily can coordinate on avoids this confusion, or if the other focal point would create confusion, either 2 or 4% are moving around, and if many economists said we should move the inflation target to 4%, they create actually more confusion going on this way. So having no ability to coordinate on another number is actually strengthening the 2% number, so we should not talk so much about the other number. So re-anchoring at 3% or 4% is actually very complicated. And on top of it, what's very important is that when you have higher inflation, of course, it's a very different mindset in people's cognitive abilities. And I think many people have talked about it, that if you have no inflation or if you have 2% inflation, you can actually ignore inflation problems altogether. So the cognitive power for people to use for inflation calculations is not there. But once you get to high inflation, everybody has to worry and recalculate constantly and think about what the inflation's impact on my own wages, on various purchases. It makes it much harder to compare prices and so forth on top of it. So that's essentially where I would come in on the inflation anchor. Now, this is also related, should we, how should we go on and tame inflation? Should we do it now or should we do it later? So of course we know that monetary policy acts with a lag. So it's less pronounced. So if you tighten now, it will only show up later. But if we act forcefully now, it also reveals the true type of the anti-inflation commitment of a central bank. So what's the true type of central bank? Is it standing up for the fighting the inflation or not? So the de-anchoring of inflation expectations is loss of the focal point. That's, this resilience barrier. You might break through the resilience barrier. As I mentioned, this depends very much. So if inflations are not anchored anymore, the inflation expectations are not anchored anymore. And this depends, how costly this will be down the road. Depends very much how people form expectations. Do they have adaptive expectations, extrapolative expectations, or rational expectations? And they're very different. So if you have rational expectations, you can more easily re-anchor, even though you have to still coordinate the higher order beliefs. But if they are adaptive expectations, then it will be very costly to bring the whole thing down. It will be even more costly if you have extrapolative expectations. And the key for all of that is, do you have a good narrative? That's one of the policy lessons. So you have to have a good narrative, not only for the failure when inflation moved up this way in order to avoid some blame game, but it also gives some clear guidance going forward. So the narrative and communication seems very important to keep the inflation anchor. And that's a big, big, big resilience component. I should say, if you look at the inflation expectations and what I've depicted here, this so-called hair diagram, we have seen many, many times what the market believes and what also central bankers believe. And in their models, they always assume, or in our models, I should say, it's always assumed the inflation anchor is holding. So the inflation anchor never breaks. But that's, of course, a strong assumption that you assume that, the inflation anchor is not moving away. And that's why you get this strong mean reversion. You can see when inflation was very low, the interest rate very low, it always, in these models, have this force. You go back to the stationary setting, then you always go back, and when it goes up a lot, you undershoot always. So that's essentially, you always try to go towards the long run mean, and that's in VIR models, that's in stationary DSG models, and so forth. You always have this transitory bias, and we have to be very aware of this. And if we go for data-driven monetary policy, there's implicitly some forward guidance in disguise in it because of these modeling assumptions. So this assumes essentially we have the stationary setting, we have an inflation anchor, but in the real world, that's not given, so we should not take it for granted. The second point I would like to make is about trap thinking. So as I said, one of the resilience killers are traps. So adverse feedback loops, once you lose the inflation anchor and then the whole thing spirals out of control, that's one thing. But the other thing is you might face some traps, and from a trap you cannot bounce back. So you might, like this fish go into this trap and then you're caught in there and then you have no resilience.
Markus, can you hear me?
And I would like to emphasize two traps. And do you want, in your monetary policy, you would like to, the strategy should be avoid traps. Always think, if I do something, will it trap me down the road that I cannot do something I should potentially do in certain contingents in the future? And I would like to highlight two. One is the financial dominance trap, and the second one is a fiscal dominance trap. The financial dominance trap, you can of course see now very clearly. You saw it in the Silicon Valley Bank and all this, where you think, oh, can we still raise interest rates and still fight inflation in the light that it might create some financial instability in various regional banks in the United States? And of course, good macroprudential regulation helps monetary policy to stay away from the financial dominance trap. And that's essentially very, very important element to have the banks well capitalized. Don't allow them to pay out dividends anymore. Now keep the capital in the banks in order to have the freedom to fight inflation. And of course, no separation here between monetary and financial stability. So there might be, if you look at monetary versus financial dominance or monetary price stability versus financial stability, if you're in a low inflation environment, then it's actually the case, if you stimulate the economy, you also, bring the inflation closer to 2% and also help the financial sector and increase financial stability. So there's a congruence between price and financial stability. But if you're in a high inflation environment, then there's a trade-off. So you go from a congruence to a trade-off. Now price and financial stability is now working the opposite direction. And if people expect that you cannot intervene anymore in terms of high interest rates because it actually creates some difficulties in the financial sector, it will move inflation expectations. It will unanchor your inflation expectations because people expect, the central bank cannot fight inflation. And because it cannot fight inflation because of financial stability concerns, people then increase their expectations and you lose your inflation anchor, and then it becomes self-fulfilling. Now, on top of it, this also holds not only for interest rate policy, it also holds for central bank balance sheet policies, so unconventional monetary policies. And for this, you have to watch out. You can do this unconventional monetary policy in the short term and really to stimulate, but you should, if you do it in a prolonged fashion, then it's actually not so helpful. Now, this interaction between monetary and financial dominance, you had this doom or diabolic loop. This played out very strongly in the Euro crisis, and we know this. So that's why it's very important that banks have some risk weights on their sovereign debt, because sovereign debt might lose its values, but we're not able to implement these risk weights in order to have enough equity. But if the sovereign debt risk is going up, the sovereign debt value is actually going down, that lowers the equity of the banks, so the equity risk goes up, and that makes actually the bailout probability more likely, so then sovereign debt risk is going up even further. So you have this huge diabolic loop. On top of it, the banks, if the equity is partially wiped out, even though you don't see it in the books because it's hidden from the accounting, they'll grant fewer loans, so it's tightening, and you see it now in the US. It's not the interest rate increase initially, which really makes the banks tighten, and it's cutting back on the lending. Now you see after Silicon Valley Bank and after the shocks in the banking system, the banks tighten a lot. That reduces the growth rate of the real economy. That actually will also then bring down tax revenue and the sovereign debt risk. So there are two loops which one has to watch out. And in order to avoid that, it's important to have on sovereign debt some risk weights. Now that was one. The other trap is, of course, the fiscal dominance trap, where we say, what's the impact of fiscal policy on inflation? Right now, we have still a thinking among many policymakers that we can spend freely, we can go into debt at a very low real interest rate, which is true because inflation is way higher than the policy rate. So it's still stimulating in this sense. So, but if you just look for the United States, if you look at the projection of the CBO, you see, this goes up to almost 200% in very stark fashion here. So there's, a huge increase of debt to GDP ratios, and that actually one has to keep this in mind as well. So that's why we have this, to avoid this fiscal dominance or to avoid that the fiscal situation is getting out of hand, we have central bank independence. And then the question is, why is the central bank independent and how independent is it? And what are the lessons from that? Now, the first thing is, central banks are independent, in particular the ECB is independent legally because it's based on an international treaty. But, international treaty can be ignored and it's not guaranteed that central banks will not face pressure. So one of the big things which will come up, not only will central banks be limited and trapped because of financial dominance, they cannot do that, the pressure from the political class on the central banks will be much more pronounced. So, we had, so far, I often say that central banks could play a Santa Claus and always give some gifts away and were very popular. if you fight inflation, suddenly you have to be the unpopular guy. You have to be using some German expression, the Krampus, in a sense, to hold against that. And so that's why you need a strong independent central bank. So it's based on legal. But the other important thing is you need a central bank which is well capitalized. So have a strong central bank balance sheet. And because whenever the central bank has to go to the policymakers and say, we need to be recapitalized. So of course the central bank can run with negative equity, but only to a certain degree. And there is some headline risk associated with that. And now we pay, with higher policy rate, there's a lot on the reserves, there are a lot of excess reserves in the system held by private banks. And if you increase the policy rate, you pay more interest payments on the private banks. And you can see how this politically may be seen that now the central banks pay huge billions of euros or dollars to the private banks. And that's actually because of QE, there are all these reserves outstanding. So there's a lot of payments have to be flowing from the central bank to the private banks. And this actually might not be very popular. And this, in particular, if the central bank has to be recapitalized, that actually might undermines the independence of the central bank. So we should watch out and all recapitalize the central bank in order to do that. And let me just make a very controversial statement. What actually makes a central bank more independent if ultimately in the subgame, when there needs to be some debt restructuring, if the debt restructuring can be done in a smooth, least costly fashion. So even though you might not end up in the subgame, you might not need to restructure sovereign debt, but the bargaining power of the central bank with respect to the policymakers is higher if it's known whenever there might be some debt restructuring, it can be done in a rather smooth way, in a not such a dramatic fashion. It's similar to too big to fail, where we know if we can restructure the bank in a way, then the central banks has more power over it, even though you don't restructure the bank. And similarly, so if having a smooth debt restructuring in a way when the banks are well capitalized and the debt restructuring of the sovereign debt can be done smoothly, that helps also the central bank to maintain its independence. And again, communication is key, of course, in this potential blame game. So controlling narrative is what gives the central bank avoiding this trap of fiscal dominance. And that's one of the traps as well. Here are just some figures. I know I'm running beyond my time. I apologize. You can see going back in history for the United States, whenever you have fiscal deficits, it translates either immediately or with a certain slight delay, it translates into higher inflation. So fiscal aspects really have implications for the thing. So we live in a new world. What's in the new world? We have high government debt levels now. So that means the monetary fiscal interaction will be much more important. The fiscal dominance elements will be much more important. If you have a low government debt level, let's say 60%, the debt burden is not so high. Now, if the central bank hikes interest rates, the debt burden will be debt service costs will be much higher. So the political pressure on the central banks will also be much more dramatic. Secondly, we have much more higher private debt level and inflation. So what was the monetary financial stability interaction? It was a congruence before. Now it becomes a trade-off. So now if you have high inflation, if you have to fight inflation, there's a trade-off between financial stability and price stability. That's different. Now we also have learned that it's much harder to predict inflation or anything to the predictability looking into the future, because we have all these particular crises, supply and demand crises. We don't know what shocks they are, idiosyncratic, systematic shocks, temporary, permanent shocks. So we have to, on the one hand, the central banks have to become more humble, and we have to keep in mind that, the policy lags, we might be behind the curve because the predictability is much more difficult to predict. Let me just highlight a few transition phases, structural changes we're going through, and that has implications for our star and the risk premium in the transition. And let me just highlight a few of them. One is the green transition, and green transition will mean that we people will invest less in dirty technologies, but they have a huge investment demand in the green technologies. So we have this huge investment, and the question is, what is the implications for R star? And as I said already, we have these transition phases, and we have to think how resilient is the whole economy in this transition phase, and how quickly should we do that? On the one hand, there's resilience with respect to environmental circumstance, but then there's also resilience on setting up the monetary policy this way. So monetary policy typically is not designed to do structural changes. So that has to come from other policy areas, but it can accommodate the transition, or at least be prepared and see what are the implications for monetary policy. In particular, what are the implications for R star and the risk premium. So for example, if the green transition leads to more investment, and that means the equilibrium interest rate R star moves up, and that also means essentially you have to tighten monetary policy further in order to reflect this R star, this higher R star. Now we have work from home. That's also a long-term transition, what the productivity and losses and gains is, labor productivity and so forth. We have these huge demographic changes. That's also, jump challenges where you move from excessive savings, depressing R star, and as the people retire and dissave, then R star might go up. And so we have also an increased R star. We have the whole effects, and Charles Goodall was talking about this very explicitly in his recent book about deglobalization. There's some efficiency losses, and this way it also will affect R star as well. And then there's also, of course, all the dimension with the digital euro, which I don't have time to go into. So let me conclude. I think resilience and monetary policy are very closely connected, robustness as well. Risk management approach we use in monetary policy, rightly so, risk management approach, we don't just look at the mean forecast, we look at the whole distribution, each probability, each scenario, but also how bad, what's the impact of this scenario. So that's very important. Resilience is also important. It's more dynamic concept. It's not just, what does it do in the next instant? It's how do we bounce back after the shock? How can we bounce back? And there might be temporary shocks from which we can bounce back, but we might also have some transition phases, the structural changes I mentioned at the end. Most importantly, inflation to bounce back, we need to maintain the inflation anchor. And maintaining the inflation anchor is not easy because people have to coordinate on this 2%, and it's, we don't want to move it around. And also there's, of course, a worry-free inflation where 2% I don't have to worry about inflation. Once it moves 3, 4, 5%, I constantly have to think about the inflation. And cognitive resources of the people, so people's cognitive resources are used for that. And finally, resilience is, of course, avoiding traps. And I outlined two particular traps: financial dominance and fiscal dominance. And we see both of them playing out at the moment. So thanks again, and sorry for taking a little bit longer.
Thank you very much. As we are quite behind schedule, I'm afraid there's not sufficient time to ask questions from the floor. So we have to move on to the next session. Markus, thanks a lot for your very much appreciated insights. I hand over to Enes Knan, the Secretary General of SUERF, for the next panel session.
Ladies and gentlemen, so we have heard from Markus that we are behind the curve. I think we're behind the curve in this conference as well right now. And I don't promise that we will fully catch up, but we will do our best. Welcome to session 1, which will deal with shock identification and optimal monetary policy responses in an uncertain and complex environment. So in a sense, we're trying to put some more flesh, some more details on some points which Markus has just alluded to. In this, and more in particular, in this session, we will investigate how to correctly identify the nature of shocks, their duration, their relative strength, for instance, supply versus demand, that has been mentioned, their transmission in an increasingly uncertain and complex environment, What lessons have we learned during COVID and during the energy crisis? What are the implications for monetary policy strategies and the conduct of monetary policy? We have a group of outstanding experts to discuss these topics in a very diverse way. Boris Hoffmann is Research Advisor of the Monetary and Economic Department of the BIS. He will offer a glimpse into current BIS thinking of how to identify the shocks which are currently driving inflation and how fiscal and monetary policies may have to change to ensure or to return to macroeconomic stability in the near future, hopefully. Raffaella Giacomini, professor at University College London and economic advisor to the Federal Reserve Bank of Chicago, will then highlight the many open issues which economic researchers are facing in actually identifying the various shocks we are confronting. Raffaella will also propose various avenues to pursue and tell us her own personal preferences. Then Adrian Penalver, Deputy Director of the Monetary and Financial Studies at DG Statistics, Economics and International of the Banque de France, will then zoom in on monetary policy. Adrian and his co-authors ask the question whether caution and gradualism are really the best route for monetary policy in a world where inflation expectations cannot be taken to be firmly anchored forever and under all conditions. The first round of our panel will be completed by Sandra Eickmeyer, research economist at the Economic Research Center of the Deutsche Bundesbank. Sandra will argue that maybe our established methods and perspectives in explaining the impact of the multiple shocks we are currently facing need considerable broadening beyond traditional tools and perspectives. May I ask our panelists to stick to 12 minutes in their presentations, so we have time left at least for some interaction with conference participants. We start off with Boris Hoffmann. I hope Doris can hear me and we can hear you. Boris, over to you.
Yes, thank you very much, Ernest. I hope you can hear me well.
Yes, we can.
Very good. Yeah, so thank you very much for the kind introduction, and I'd like to thank the organizers for including me in this very interesting session. So I hope you can see my slides now well. Can you see them?
Not yet.
I shared them.
Yes.
It's fine. In any case, before I get to the content, before you maybe see them, let me emphasize, of course, that the usual disclaimer applies. So all that I'm going to say in the following reflects my own views and not necessarily those of the BIS. Now, assuming that the slides are visible for everybody in the room and also virtually, so what I'm planning to do in my talk, I want to focus on two questions which are directly related to the topic of the session. The first is the question of shock identification, so the question which tools worked. And what I will argue there is that actually it seems that very primitive analytical frameworks and indicators gave signal before the inflation surge in a very complex environment. So what I will suggest is that actually very basic empirical demand and supply framework gave a signal that inflation was driven by very strong demand, which hit very tight supply conditions. So this is based on a recent working paper together with Sandra Eickmeyer, who's also on the panel here today. And also money growth, a very, very simple and actually unfancy indicator, also gave clear signal before the inflation surge, as we documented in a recent BIS bulletin co-authored with Claudio Borio and Egon Zakrajček, which came out earlier this year. The second question that I want to raise is on the policy responses. So the question, how did we get there? So how did we get into the policy constellations that then ushered in inflation surge and more recently also financial stress? And here what I want to suggest is that is the cumulative effect of sequential policy responses can take the policies to the limit, and that this is something that also needs to be kept an eye on beyond the challenge of the day. And this is also a point that has been elaborated on and developed in more detail in a recent speech by Agustin Carstens at Columbia University a couple of weeks ago. Now let me go to elaborate on the first question, the shock identification, the question which tools worked. So in the paper with Sandra, what we do in this paper, we use a very simple supply and demand framework to identify indicators of demand and supply conditions. So the identification approach relies on very basic economics, essentially the consideration that an expansion of demand would increase economic activity and would also increase inflation, while an expansion of supply would increase economic activity and would tend to dampen inflation. And we use these very simple sign restrictions and apply them to a factor model, which we estimate on a large set of inflation and real activity indicators, both for the United States and for the euro area. And we use these loadings to rotate the factors to identify demand factor and supply factors. And these factors then enable us to assess the stance of demand and supply in the course of time, and in particular also in the very recent period. And when you look at the outcome of this procedure, which you see here for the US, where we estimate the models over the period 1970 to 2022. So what this suggests here, what you see here, the red line is the median of the factors that were identified by the model that fulfilled the sign restrictions, and the black lines around it is the range of all the factors that fulfilled the sign restrictions in the procedure that we applied. And the range goes from 1970 to 2022. Positive values indicate strong demand on the left. On the right, it would be strong supply, and negative value would mean tight demand or tight supply. And what you see in this chart, the main takeaway is that this very simple analysis already in 2021 actually signaled that demand conditions were extraordinarily strong. So we're already very near actually historical peaks, and at the end in 2022 actually above the values that we estimate that prevailed in the 1970s, where we had the great inflation. So this is what you see on the left. And on the right panel, what you see there is that these very strong demand conditions actually hit at the same time very tight supply conditions. Yeah. So this very simple model indicated that demand was very strong, and it indicated that already in 2021. So actually, well before the policy, the monetary policy hiking cycle actually really took pace. Now, when we look at the euro area, we get a very similar result. So here we estimate the model over 1999 to 2022. And also here on the left side, we see already around the end of 2021, there were clear indications of very strong demand conditions. And this also hit again very tight supply conditions, which are in fact even historically tight in the case of the euro area at the end of the period in 2022, reflecting the greater exposure of the region, obviously, to the adverse supply effects of the war in Ukraine. Sorry, it was too fast. So in another piece of analysis, which is related to the question, together with Claudio Boio and Egon Sakrajček, what we look is at the question to which extent the surge in inflation has been related to money growth, which is obviously a very simple and also, if you want, has become a very unfashionable indicator of inflation dynamics. And what we find in this analysis is that actually money growth gave also the signal very early on. So what you see in this chart is the link between excess broad money growth during 2020, from fourth quarter 2019 to fourth quarter 2020, and how this is related to average annual inflation between Q4 2020 and Q3 2022. And this is done for a set of advanced and emerging market economies. And what this left-hand panel suggests is that, in fact, the strength of money growth during 2020 had a clear positive relationship with inflation outcomes in 2022. So it gave a signal of the inflation surge that was in the pipeline. And what we also find is, what you see in the right-hand panel, is that money growth also appears to be able to explain inflation forecast errors. So what you see there is that the excess broad money growth between 2019 and 2020 was also positively related with inflation forecast errors that were made in 2021 and 2022, a result which essentially suggests that the information content of money growth was apparently not factored into the construction of inflation forecasts at that time, which is probably not surprising, given that money growth is obviously not really an indicator that that has received a lot of attention at that time. Now, when you look back in history, obviously, the finding that there has been a positive association between money growth and inflation is maybe not too surprising, and it could possibly reflect the dependence of the strength of the link with the inflation regime, because what is a well-established finding, which we also reproduced or recall in the bulletin, is that the link between money growth and inflation tends to be very strong when inflation is high, while it tends to be very weak when inflation is low. So this is the bottom line of what you see in this panel. So the left panel shows the association between money growth and inflation across countries, where you see it's scattered around 45-degree line, but that this link is clearly driven by the high inflation, high money growth observations. And also when we do more formal regression analysis, what you see in the right-hand panel, you see that in the high inflation countries, which is the red line, there's a clear one-to-one relationship. But in low inflation countries, it's actually insignificant when you go down to average inflation rate levels of around 2-3%, and only then starts to rise when you increase this inflation threshold level that would define a low inflation regime. So overall, this suggests that maybe this link between money growth and inflation that we observed in the recent period could have been indicative of this risk of a transition from a low to a high inflation regime, which was also discussed in some more detail in an economic report chapter last year. And here we add the consideration or recall that also the money growth and inflation link could be indicative for such regime shifts. Now let me turn to the second question briefly, the question on the policy responses. So how we got here. So when you look at the trajectories of monetary and fiscal policy from historical perspective, then what you see is that both monetary and fiscal policies had reached extremes prior to the surge in inflation that we saw, that we observed recently. So what we see in the left-hand panel is that interest rates have been historically low, while central bank balance sheets, which is the yellow line, had reached historically high levels. And at the same time, what we see on the right is that fiscal deficits tended to take larger and larger levels in each of subsequent recessions. And this was then associated with an upward trend in the level of public debt. And what this suggests is, what this visualizes, is that how sequential policy responses over the past decades, how they pushed policies more and more to the limit as downturns essentially triggered even stronger accommodation, but at the same time, the upswings that followed, that did not lead to rebuilding of policy buffers. So this is what you see here when you locate here, like the GFC, in the COVID crisis, you see that there was always these upsurges, but then in the recovery, we didn't really get back to the levels that we had seen before. And this becomes even clearer when you look at the trajectories of interest rates and debt around recession dates. So this is for a set of advanced economies around recession dates, trajectories, so the averages of the variables around these dates. And what this chart shows is that how the recessions since the 1980s, which is the blue line, were associated with persistent decline in interest rates and very persistent surges in public debt, while the recovery or the boom that happened before the recession was actually not associated with significant increases in interest rates, and also not with reductions in public debt. And what this chart also shows, that there was a clear change in that pattern since the mid-1980s, because in the period before, we didn't see such a similar pattern emerging, as you see here with the red lines. Now let me conclude. So what the main takeaways of my short presentation are. So on the one hand, suggest that simple analytical frameworks and indicators, they seem to have given signal of demand or policy-driven inflationary pressures building up before the inflation surge, which suggests that there might be a need to watch out for extreme signals including maybe from methodologically unappealing and simple tools or indicators. And secondly, that the cumulative effects of policies, that they should also be taken into account in the policy conduct over the cycle. So when you look back, policy responses were of course always compelling in each point in time, but cumulatively, they probably pushed the policies to the limit, which probably means that we need to look beyond the challenge of the day and try to preserve the buffers over the cycle. So thank you very much.
Thank you very much, Boris, for your analysis and also for sticking to the time. I take along, among other things, that we could or even should have known earlier that inflation would rise due to the combination of excess demand and severe supply shocks. Now I turn to Rafaela to double check. Is shock identification clear and straightforward, as implied by Boris? What might be the problems and what might be possible solutions? I hope you can hear me and I hope we can hear you.
Yes, I can hear you. Can you hear me? Can you see the screen?
Excellent.
Perfect. Well, thank you so much for inviting me here. It's a very interesting and diverse panel and conference. So I'm very happy to talk about what I know best, which is how do we deal econometrically with uncertainties about identification and measurement of shocks. Okay, so again, the usual disclaimer applies. These are just my views, not those of the Federal Reserve Bank. Okay, so how do we do, this is sort of like a textbook overview of how econometrically and empirically we deal with shock identification and understanding the effect of shocks. And so I will talk about two types of uncertainties. So the first one is about, as Ernest was saying, identification of shocks. Okay, so why are we uncertain about that? So a shock is really what the beholder or the econometrician or the empirical person thinks it is. So I will talk about two main frameworks for doing monetary policy analysis, or in general, understanding the causal effects of shocks. And the first one we're all familiar with is these structural VAR models. Okay, so in a structural VAR, we would like to give a structural interpretation to our the effects of shocks. And of course, by doing that, it means that what we call a shock really depends on the identifying assumptions that we need to impose. So this means that we have two different studies that use different identifying assumptions and maybe even the same model, then we cannot really compare the conclusions of the studies and we cannot really quantify the effect of shocks in a way that we can all agree with. And so this has been a fierce debate going on in the profession for decades. And it's fair to say that we haven't come to an agreement. And so this means that we cannot really give an uncontroversial answer to what is the actual effect of shocks. So how do we deal with that? So there are a couple of ways that we can go about it econometrically. So when we're uncertain about the identification, so one thing we can do is just relax the identifying assumptions. So this has been a general move towards having weaker assumptions and trying to understand what the model actually says, which is not just what the researchers has imposed through identifying restrictions. And so this is possible. It just means that, however, you're not going to be able to have a point estimate of your effect of the shocks, your impulse responses. And then instead, what you have is a set or an interval. And so there are pros and cons to the different approaches. So a pro is that we can now, once we relax the identifying assumptions, we can compare different models or studies. And what we find there are truly reflective of what's in the data and in the model and not mingled with the arbitrary assumptions that the researcher has imposed. Of course, the downside of that is that working with intervals means that, first of all, they're difficult to communicate, and typically they tend to be very large. So in a sense, that they may suggest that there is not an effect. And so in a way, you can think of this as having too much ambiguity. So to give you a sense of what this looks like, so this is a classical, what is the effect of a monetary policy shock on real GDP? And so the dotted line is what we would typically, what we teach our students. This is the classical Cristiano, Eichenbaum, and Evans set of identifying restriction, this recursive identification. And so we see here that this is an informative impulse response. because we see that at some horizon, we do have an effect of monetary policy on output. And these dots, and then we have confidence bands. So the moment we relax these identifying assumptions and we're more agnostic, if you will, then what we report instead are these vertical lines. So these are sets. And so the impulse responses could really be anything, positive or negative at all horizons. And once we construct some measure of uncertainty around that set, then this becomes even less informative. So of course, we don't like this. It's hard to publish papers that look like this. And so an alternative, we can take one step forward and we can think about, okay, there is ambiguity. We have a lot of ambiguity. Can we make an optimal decision in a sense that has to be specified? And we have all this literature that we know of, like Hansen and Sargent, robust decision. This is a decision ultimately. So we can try to be risk averse as policymakers, as researchers. And instead of reporting the whole set, we can try to pick a particular point within the set. And of course, we have to decide which point makes sense, and we can think about minimizing perhaps the maximum loss over that interval. So this has advantages in that we can easily communicate a point. So we're back to saying that the effect of a monetary policy on output is that output goes down by a certain number. The downside is that how we pick this particular point is still arbitrary. So it's not due to the identifying restrictions, but it's a loss function. And also how we choose the neighborhood around a particular point. So there is no free lunch. I'm sure that you understand this. So this is about uncertain identification. So the second type of uncertainty is about is moving away from this framework of structural VARs and trying to measure the shocks directly. So this is a very popular alternative to doing restrictions in a VAR. And it's about these narrative measures of shocks. Okay, so this goes back to Romer and Romer. And the idea is that instead of trying to do this system identification, why don't we try to measure the shocks directly, either by reading the minutes of the FOMC meetings or doing some automatic text analysis by AI or looking at how markets react, how the expectations of markets react to policy announcements, looking at very short windows around an announcement. Okay, so if we believe that these measurements are the true shocks, then this is great because we can get some dynamic causal effects by simply doing some local projections. And then we're back to point estimates that we like to work with. Now, of course, the con is that these probably are not the true shocks. So, we decide, we read the minutes and we think, okay, this was a shock in the sense that this was truly unanticipated by the markets or the agents. And so the profession has acknowledged this. And in fact, there's a way to deal with this type of uncertainty if we think that the uncertainty about measurement is a measurement error type of uncertainty. And so that means that in practice, instead of treating these as true shocks, we treat them as instruments for the shocks. And then in that case, we can use IV estimation to deal with that type of uncertainty. Okay, so the advantage of this is that we don't need to assume that these shocks are correctly measured. The con, of course, is that we're an instrumental variable, so the instrument may be invalid, the two usual problems. It can be weak and has been found to be weak. And moreover, more importantly, it can be not exogenous in the sense that there are some of these, if we construct the sequence of shocks, there could be some of these historical episodes that we called shocks that were not truly unanticipated. So how do we deal with that? So the profession has acknowledged this and then has tried to kind of zoom in on a few historical episodes, only a few of these long Romer and Romer series of shocks by trying to focus on a few episodes that we can all agree that were truly unanticipated. And then the framework is there to impose these as identifying assumptions in the context of a VAR. So it's kind of going back to treating these episodes as restrictions. So this has an advantage in that it can be viewed as imposing very minimal assumptions, and we like that. Of course, that minimal assumptions mean that the informativeness is perhaps that we have less informativeness, and we're going back to having to report set estimates instead of points. And so finally, and this is what I'm working on at the moment, we can try to think about these same few historical episodes that we can all agree were truly unanticipated. So, and this has to deal with, it's a solution also to this idea of a more complex environment. Perhaps we don't really understand if markets are aware of changes or not. So let's try to focus on a few episodes that maybe were predating the pandemic. And then so what we end up with is that we construct an instrument out of this. So this instrument will have a lot of zeros. So there will be only very few episodes that we think constituted a true shock. And so for that, we need new econometric tools, and we're working on that with co-authors. And so the advantage of this is that it gives you back a point estimate. And then the idea is that it's efficiently extracting information from these few episodes that we truly, we all agree are truly exogenous. So now the cons, of course, now we're still in the exciting phase of the paper, so we think there are no cons, but I think what we're going to find again is that because we're focusing on very little information, we're probably not going to get that much power out of it. So we'll probably get very wide confidence intervals. So just to conclude, the bottom line is just, when we do policy analysis empirically, econometrically, we need to worry about underlying uncertainty. So one is an uncertainty about identifying assumptions that are hiding behind our definition of shocks, which really depend on the model. And then secondly, we have to worry about the measurement of shocks. Are these truly unanticipated shocks? Are there truly unanticipated changes in interest rates? Or did the market, or did we all know that the Fed was going to raise interest rate in this environment of increasing communication? It's kind of hard to believe that there are truly unanticipated shocks. Okay, so what I think are the two most promising solutions is, one, be very honest about what's in the model, what's in the data. So by relaxing all of these extra assumptions that we impose just because we want to get a point and we're not happy with the underlying true measure of uncertainty, which is captured by a set of possible effects of policy shocks. And then we have to get familiar with reporting these sets instead of points, or we can try to get a point through this instrumental variable approach, but then we have to focus on the few historical episodes that are truly perhaps noisy measurements of the underlying shock. Of course, the risk in both approaches is that we find that there's very little we know about the effect of shocks. Our models, our data don't give us that much. But just to quote in closing Mansky, I think it's important that as policymakers, we make decisions that truly acknowledge what we do not know about the data. Otherwise, we risk making policy decisions that are driven by incredible certitude. Thank you for your attention.
Thank you very much, Raffaella, for sharing with us your important thoughts on how to get a grip on various shocks and their identification in this period of multiple shocks. We now turn to Adrian for his take on how monetary policy should deal with this, what the conclusions might be.
Thank you very much, everybody. As Ernest said in the introduction, I'm the deputy head of the Department for Monetary and Financial Studies. We are both the research department and the one that does policy. And I'm going to be wearing both hats during this presentation. First of all, I'm going to present a research paper that's called A Pitfall of Cautiousness in Monetary Policy. And if you're advising young academics, you tell them to treat a very narrow subject and write about 60 pages of dense mathematics to get it published. So the background paper that's here follows that. But I hope in the second part to be able to tell you that, or convince you that what's quite a narrow topic will have quite general policy implications, quite wide policy implications. The first part that deals with research implicates the two other co-authors on the slide, Stéphane Dupraz and Sophie Guillaume-Nefoussi, but not the part on the policy conclusions, and none of it should be considered to be either the views of the Banque de France or the Eurosystem. Okay. There we go. Okay. Here's two quotes from two well-known policymakers when they're talking about what you should do in the face of uncertainty. From Mario Draghi in March 2019, you do just what you think is right, and then you temper with a consideration for uncertainty. In other words, in a dark room, you move with tiny steps. Jerome Powell in Jackson Hole gives a kind of similar flavor. When unsure of the potency of a medicine, start with a somewhat smaller dose. And these are very, very powerful analogies. And people who are central bankers who want to sort of channel this, this intuition sometimes give it a theoretical gloss, citing Brainard from 1967. And I give you a list of famous central bankers who have done this. Now, this is a paper that's going to tell you that maybe this Brainard uncertainty is not quite as solid an argument as it's made out to be. So to do that, I first need to tell you what I'm talking about. So I'm going to take one slide to explain Brainard, the conservatism principle, and then how I'm going to criticize it before turning to the policy implications. So I promise you there's not much more maths than's what on the top slide. So we're going to consider a really, really simple inflation process where inflation today is equal to the inflation target, and then you can move the nominal interest rate, which is I, and it will, by some factor phi, will increase or decrease inflation. So the more you increase the interest rate, the lower inflation will be. And then there'll be a shock epsilon t, and everybody's going to observe what epsilon t is under the simple story I'm going to tell you about. Now, the first thing that's not clear when you hear people cite Brainard uncertainty is it's strictly about uncertainty about the value of phi. So it's not about uncertainty about the state of the economy, it's only about the way in which the transmission mechanism will actually work. So it's about the variance of phi. And he was trying to respond to what was called the tail certainty equivalence hypothesis, which said that under state uncertainty, you should just always do what you think is your best guess. Okay, so what is, I think I have to press this button twice, okay. What is the problem with when you have uncertainty about your instrument, which is about or the power of your instrument, which is this phi? So imagine you know what epsilon is, and in order to hit your inflation target of pi star, what you could do is just reverse the shock. And that could be, that's a very simple policy rule with an I with a little hat of epsilon over phi. But if you were to do this and there is uncertainty about phi, then actually the the variance of inflation relative to target is now this squared term on the left. It tells you that the more you use the instrument, and to a squared degree, the greater the uncertainty in the deviations of inflation from target. So there's actually policy-induced variation in inflation. Now, once you do this, you realize that there's now a tension between hitting the target and this policy-induced variation that you want to avoid. And in all standard kind of economic trade-offs, you do a bit of both. And so the optimal thing in the Brainard paper is that you take the best guess, or the one that exactly reverses the shock, and then you attenuate it by this factor that you see on the bottom of the screen. Okay, so this is exactly the mathematics of the quote from Mario Draghi. You take your best guess, that's the I squiggle on the right, and you temper that by the factor on the left. Okay, but what is the problem with this? And we were amazed to discover that nobody had really done this before. I mean, what do you do if you start to put rational expectations into this? What if people can see the shock and then they know what the central bank is going to do, they know its reaction function, and therefore they incorporate that into their inflation expectations? And once you do the maths, you realize that the Brainard attenuation principle is completely counterproductive. Because what happens is, imagine you have a positive shock, and this is observed by everybody, but everybody knows that the central bank is going to attenuate its policy. That means it's not going to fully offset the shock. So everyone is going to expect that the inflation rate will be above the target. But if you look at the way the maths work, that means that inflation today is going to be higher via the rational expectations, which in turn will push up inflation again. on which the central bank is then not fully attenuating because of its worry about Brainard uncertainty. And if you keep going all the way through, you end up finding a beautiful symmetric result that says, actually the central bank has to do exactly the same interest rate as it would do under certainty equivalence, but the level of inflation is even further from the target than it would be. And that's because the more the central bank is forced to act, the more there is this policy-induced variance, the greater the central bank, the more it's trying to play off this trade-off between the two, and that will only end up in that equilibrium when the deviation is very, very large. Okay, now in the paper we prove that this is not just for the simple process that I explained there, and that it's kind of 80% of the paper. But there's two extensions I just want to mention to you. One is that there is still some scope for attenuation, that is opting with a bit of kind of tempering, if inflation expectations are not based on full information. So in the paper, we take a sticky information model and we show that that gives some margin for the central bank to initially act with an attenuation, but eventually it has to track this same natural rate of interest over the course of time. The second extension that we do in the paper is to think, well, actually, the root cause of all this is the problem of discretion and this concern about inflation deviations. Now, if you did your undergraduate or your graduate studies when I did, you would know that I have some echoes of the Rogoff principle of how to deal with the kind of unemployment bias. And here, what you can do, and what we show, is that the optimal thing to do is to appoint a less risk-averse central banker. That's one who's going to really focus on the target and not be quite as concerned about the deviations of inflation from target as society might be itself. But what is important to realize is even when you think of what's the optimal central banker, they're never going to go to that full certainty equivalence solution. Now, so that's the first part about what's in the paper, and I'd encourage you to go away and read it if you want. Now, what kind of policy lessons do I think we can learn from this? Well, first, I think it actually applies to a lot of things that we're dealing with right now. We're really quite unsure about the transmission mechanism, about the IS curve. I mean, if you've been following ECB speeches, a lot is about how much of the transmission of what we've already done has already happened. We're really not quite sure about that yet. A second would be, as you tighten policy, and a little bit of this echo from Markus's presentation, you can end up with this risk of sunspot equilibria. So maybe the central bank doesn't want to really tighten policy because it's worried that it might tip into financial crises or banking crises. And also the Eurosystem has been experimenting with a lot of new instruments. So this question of what's going to happen when you pull a lever is clearly much more relevant in the face of new instruments. So I think it covers a wide range of things. I want to, so this is the last slide. I just want to tell you that what I'm talking about here is not quite the same thing as gradualism in the sense of Woodford, where a central bank doesn't act, takes time to do something, but eventually does and has a very persistent policy. Because that's more about the intertemporal trade-off between when policy is tightening. A bit less now for much tighter into the future. Here we're talking specifically about attenuating policy as a one-off event. You shouldn't get the flavor that what I'm trying to tell you is that the central bank should always just ignore this instrument uncertainty. In fact, it is a genuine problem. And the optimal solution is not just to pretend that it doesn't exist. There will always still be these trade-offs that the central bank will have to make in terms of isn't quite sure of what the impact of its policies are going to be. And one way of sort of very intuitively characterizing this risk is an overshooting risk, that you end up going further or the impact of your policy is much stronger than you expected, and then you end up with inflation well below target in the opposite direction. So it doesn't help to just pretend that this doesn't exist. But there's also no easy way to calibrate the appropriate response. So I'm just telling you that policy is even more complex than policymakers thought it was already. But you shouldn't think that... But the big risk here is in assuming that inflation expectations are unaffected by acting cautiously. So the room for maneuver is really only strictly whilst inflation expectations are really anchored around the target. My final point is, I've actually argued why I think having the TPI was so that's the transmission protection instrument, is actually quite an interesting argument as to why you want to have one of these, is because that's one thing that offered us a degree of insurance against some of those sunspot risks, and therefore took some of that risk off the table, and therefore gave some credibility to the ECB in being able to actually react forcefully to the inflation surge once it saw it was happening. So, thank you very much.
Thank you very much, Adrian, for fleshing out so clearly the theoretical arguments underlying the arguments of doves and hawks in the central banking world on both sides of the Atlantic. I think basically much of the argument is shown in your short presentation, interestingly. I think, in fact, the issue might be more complex than you just outlined. And I think Sandra is now the person who will point out what other complexities might be there and how we might further broaden our view. Sandra, can you hear us? Yes, you are here.
I can hear you. Can you hear me?
Yes.
Okay, super. So thank you so much for the invitation. And let me just read the disclaimer. These are my own views, not necessarily those of the Bundesbank or the ESCB. And yeah, here's this quote by Albert Einstein: "No problem can be solved from the same mindset that created it." And this presentation will be really about this. So yeah, the session is about shocks and shock identification, and the question is really, what are the shocks we're seeing? And Markus talked about the poly crisis, and I would say they may even perhaps be best characterized as a meta crisis, as philosophers increasingly call it. So there are multiple crises, both external and internal, including an ethical crisis with various injustices, also an existential crisis, and also a crisis of perception and sense-making, which means that we don't really understand what is going on. And clearly the crisis, that's why it's meta-crisis also, they're overlapping and intertwined. That means once you tackle one crisis, it has effects on other crises. And so we may want to take this into account. And so there are more and more people actually from different fields suggesting that the meta-crisis may be related to our minds or consciousness or values or worldviews, something that is relatively little talked about in economics, perhaps with an exception being Carney. And that's something I will explore. And specifically, I'm going to talk about consciousness, which is defined here as awareness of reality, including of who we are, which is a deep knowing beyond perception with the five senses. So something we can't really see. And the question is really, you know, whether we're willing to step back a little bit and to open up to a larger framework, perhaps a meta theory, or physicists that talk about the theory of everything, in order to understand the different crises, how they're interlinked, and the underlying structures and causalities possibly. And we may also want to open up to other disciplines, which is always a challenge because of different languages. And this may become a challenge here as well, but you'll see. And are we also willing perhaps to ask ourselves these existential questions again? Who are we and what is reality? And so the question then is, are there implications for economics, and what are they? So let me begin with something that gets us closest to where I want to go in economics. And that is recent suggestions, for instance, by Mariana Mazzucato and Mark Carney, to bring back in ethical values in economics. And Mazzucato, she made this point very forcefully, that the main problem is that economic value and ethical values, they are misaligned. And once you fix that problem, you can possibly solve most, if not all of our problems. But when we talk about ethical values, there are a couple of questions we also have to answer, which are: how are values grounded? Are they normative or positive? Are there universal shared values? Are humans innately good? And why would people live according to values? And it's not enough to talk about values or to enforce them in some way, but values really need to be deeply anchored in people's minds. Otherwise, philosopher Hannah Arendt said, morals can change as easily as table manners in difficult times. And we've seen that in the past. And so she continues, people need a dialogue with themselves. They have to be true to themselves. The benchmark is the self. And so the next question is obviously, what is the self? And that's a huge question. And I'm going to draw in the following from two large consilient frameworks. They're interdisciplinary, and consilience means that you take the commonality of findings from different disciplines and see what is common and take that out and see what is there. And so one is the integral framework by philosopher Ken Wilber, which is based on wisdom traditions and philosophy, psychology. And the other one is the interpersonal neurobiology framework by psychiatrist Dan Siegel, which is based on psychology, neuroscience, systems theory, and also physics. And so I want to give you the essence, and it's pretty clear, that may be something you may not have expected, or you may not expect, or that may be new, but just bear with me for a moment. And so this is really the essence of what I think we need to understand, taken from the integral and the IPNB frameworks, and you can find references in the book by these authors. So there are two realms of reality, two perspectives of reality, or two ways of seeing the world, if you want. In this first realm of reality, which is the Newtonian worldview, we identify with what is called the separate self, the bodily separate self, okay? Because I perceive myself in this body, I perceive you in your body, and so we perceive each other as separate. It is all about survival and adjustment to the outer world. And really, this is how we perceive the world. It is out there, it's separate from us, we can observe it with our five senses. There's focus on material objects, on behavior, there's causal mechanical interaction, there's predictability, and also fear of uncertainty, and feelings of people of separation and scarcity. And from a scientific point of view, much of this is consistent with Newtonian physics, but also the so-called default mode network, which is built in our nervous system. And when we feel threat, it gets activated, and we make in-group, out-group distinctions, or me versus other distinctions. And so that kind of reinforces the sense of a separate self. And the second realm of reality includes and transcends the first realm. And the question is really, is that a new emerging worldview? And this is something we may want to pay attention to. We no longer identify with a separate self, we no longer feel separate, but we identify with what is called the extended self or the integral self. It's also called being or existential levels or human nature, and that's something classical economists still paid attention to. And so what are the key ingredients? There's a field or a ground from which everything arises, which is potential and which is identical to all. And in the field, we realize connectedness with another, with nature, with future generations, in the sense that we feel that our self extends to another, to nature, to future generations as well. We realize also in the field compassion. It's the realm of no time, vitality, meaning, the freedom to be who we are actually, free will, creativity, abundance, wholeness, autonomy, and also there's unpredictability in the field, okay? So it feels like a total different world, basically. And we can access the field not through rational thinking, but with awareness. But when we are still identified with a separate self in this first realm of reality, then we're afraid of uncertainty. And the field is associated with maximal uncertainty. And so we fear access of the field, basically. From a scientific point of view, the DMN is inactive. And it's consistent with systems theory. And just let me give you very briefly the essence. Dan Siegel, in this IPNB framework, he has a systems view of the brain and of social groups or society, okay? And then the mind and the self, they emerge from interaction of the elements of the systems. And so it makes no sense to consider a separate self. And then Siegel and many others, they call it even an illusion. It's an illusion because that's not all of reality. There's something more. There's also an analogy which I find very interesting with quantum physics, which I don't have the time to cover. But quantum physics is increasingly popular. There has been a Nobel Prize awarded to it this year, and so we may want to pay attention to it. What is also important, I think, is that from a developmental perspective, the first realm is associated with the first half of life. As individuals, we come out of the womb with our mother, we feel one with our mother, and then we differentiate as individuals. And it's all about survival and adjustment because we still depend on our caregivers. And the second realm is associated with the second half of life. So when we're adults, we can become aware also of the field. And so it's more about being or just existing. And that's very important because it suggests that there's a direction of change towards higher consciousness in the sense that we realize a larger reality and goes along with more integration, which is a differentiation and a linking both, actually. And people have argued that this not only holds for individuals, but also for societies. And finally, I talked about values and the mindset. So Wilber calls the first realm flatland. So he says there's no inner and there are no values, therefore. So everything is really flat. Kani talked about flat values. Values are reduced to outer, often quantitative goals. Whereas in the second realm, we can actually answer the questions I've raised just before. And the values are basically who we realize we are: connectedness, compassion, freedom, etc. And we can exercise free will and live according to values regardless of the circumstances. So there may be a worldview emerging, and also which is related to higher consciousness, actually, and also the crisis may be related to limited consciousness. And so, what are the implications for economics? I have 2 more slides. So I think there are 3 systemic issues. One is that the economic system is a reflection of the first realm of reality. The focus is on separate individuals, which maximize their own material well-being on the outer, and this is also about scarcity. And there's no direction of change. And it's not surprising, because if the majority of people are living from the first realm, this will be basically everything that will be constructed from the first realm. Second systemic issue is that there's a negative feedback loop between our minds and markets. So first of all, markets keep us stuck in the first realm, and one channel is these incoherent narratives. They get wired in our brains and become our beliefs and identity. And I think economists, they increasingly get interested in narratives, and they know about the powers of narrative. And this point really, what is really important is that markets have an effect on the minds, and that's something that is often not taken into account. And conversely, markets don't work well with limited consciousness. So when we don't feel connected, we produce externalities, which is, by the way, a term from the first realm, because there's nothing external in the second realm. There are other market failures or an outcome that does not reflect who we are at a deeper level. And the third systemic issue is related to the relation between the economic system and its environment, which are also other systems such as nature, health, art, etc. And so a complex living system needs to be both closed to handle complexity, but also open to survive. So we need to pick up signals from the environment and adequately respond in order to survive. But openness involves the mind. What it needs is a sensing of the environment so that the system and the environment can co-emerge. And that's not taking place currently, but what's happening is that we superimpose economic principles on other systems, and that threatens not only survival of those systems, but also survival of our own economic system. And here comes the last slide. The question is now, where do we go from here? Here's a proposal that I can just throw in, given the short amount of time we're having. So the proposal is that we realize consciousness as a coordination mechanism in addition to markets and government. And that's something Sharma and Kaufer from MIT, they've suggested that already. They have derived implications for leadership and organizations. They're specialized in that. But there are many more implications for goals in economics, communication, the way we deal with uncertainty, prediction, how the economy relates to its environment, research, etc. And there's no time to talk about these things. And yeah, there are many advantages. Let me just list some of them. Probably the most important thing is that it roots economics back into reality, but this time a larger reality, which includes the second realm. And it's consistent with the direction of change, with people's actuals and potential mindsets. People may be able to develop towards this second realm of reality. Markets will work better, and consciousness development unfolds by itself if it's left undisturbed. And that's similar how liberals argue, you know, or we were hoping markets would work. Just leave them undisturbed, don't disturb them, and they will work by themselves, which now we understand it doesn't really work. And the reason may be precisely related to what I was talking about before. And there are other advantages. We can address the crisis jointly and hence more effectively. Meadows, she has a list of leverage points, places to intervene in a system in order of effectiveness, and the mindset is the most effective leverage point. We can consciously shape change rather than react to crisis, given that we know about values and the direction of change. Outer change is sustained by inner change. It has to, especially given the technological advances that lie ahead of us. And finally, we can contribute to people's freedom and well-being and peace in the world. And maybe let me just finish with one sentence. So we can honor achievements of modern economics. In particular, it's so important that basic needs of all people are met. And that's really the prerequisite of moving on also with our minds and consciousness. But ultimately, everything that kind of omits what is the core of our existence, which is consciousness, and the second realm cannot be sustainable. Thank you very much.
Thank you very much, Sandra. We're a little bit behind time. The next session starts at 4:15. I would say we give ourselves 5 minutes for 1 or 2 questions, if there are any. So, yes, please, Jakob, and I can't see well. Yeah, yes, Francesco Papadia.
Thank you very much. I have a question to Boris. Listening to your presentation, I thought, oh, it's just like reading a recent SUERF contribution by Guido Ascari and his colleagues. They come up with precisely the same story that, you know, it has always been in each phase of the inflation crisis, a combination of demand and supply shocks. It's never just supply shocks, in contrast to what many people seem to believe. So, and I totally agree with that. The main question, however, that comes out of your analysis and that of Ascari and co-authors is, what explains then, if it's so obvious, that central bankers for quite some time had it wrong? You know, they thought that inflation would be temporary, and in fact, I still remember some forecasts that within a very short period of time, inflation would be back to below target levels. So what went wrong? I mean, if it's so obvious from your macro 101 apparatus that inflation would be here and probably would be here to stay for some time, why did central bankers have it wrong for so long?
Francesco Papadia.
Well, thank you very much. My question is for Raffaella Giacomini. And the question is, what does she think of another way to measure shocks, which starts from the observation that during crisis, forecasts change a lot over time. And if you think that forecasts are a summary of the conditions of the economy at a certain point in time, and forecasts change, that means that the state of the economy has changed between the time of the two forecasts. And you can take that as evidence of shocks. So something that was not known when the first forecast was made is made apparent when the revision of the forecast is made, and this is a shock. Now, this would be a very easy way to measure shock. Just how much do forecasts change from one period to the other?
Final question, Jon, and then I'm sorry we have to cut.
If I can perhaps ask a slightly more philosophical question, since the panelists have all been highlighting problems or challenges to policy making. And what we have been seeing over the past 15 years or so, central banks are getting increasingly more powers. They're involved in more and more areas, and every day it seems like they are moving to yet another domain. But with all these uncertainties in identifying shocks and what we are measuring, is it a good idea for the central banks to move into so many new domains, given all the measurement problems the panel is highlighting?
Okay, thank you. Boris, you ask first. You want to go first?
Yes, many thanks, Ernest. Yes, I think this is a very good question that Jakob raises. I don't really have a very good answer to it, however. I think at the moment there's obviously quite a bit of soul searching going on. So I mean, there are also many articles in the press. So why did this inflation surge? Why was it missed? Is there need to revisit the way forecasts are constructed? So I think there's obviously a need for that. I mean, maybe it's the case that there's a lot of focus on very sophisticated tools, where maybe these simple signals do not come out as clearly anymore. Tools that maybe also have some specific features which are important, like some like mean reversion ultimately, but then obviously wouldn't capture like persistent effects of shocks as we see them now. Yeah, so this would be my broad answer. My main point was just to say that the very simple tools, they seem to have given signal, and that suggests that maybe one would need to go back and check the more sophisticated ones, and compare the signals. And if the signals were not as clear in the more sophisticated tools at work, then maybe checking why that was the case.
Thank you. Second question was to Francesca.
Okay, so very briefly, I also don't have a very good answer to that. It's an interesting question. See, the problem is that all of the tools that I was talking about assume that there is no change, right? So we're really relying on stationarity and regularity. We're looking at the past to learn about the future. So implicitly, we have these constant parameters in the background that are kind of giving us the answers. So I think it's interesting, to try and incorporate potential change, and then we will have to start modeling maybe how the change is different between the markets and the policymakers, and maybe try to carve out some identifying restrictions from differential assumptions about change. I think we can do something like that. I'll definitely think more about it. It's a very interesting question.
Thank you. We have the philosophical question on mission creep, basically. So maybe, Adrian, you might.
I inherited the poison chalice on that one. I do remember a front cover of The Economist, it must be about 20 years ago, where it was, central bankers, masters of the universe. And that was certainly a world in which we really did think that there were levers that we could just pull and magically inflation would return back to target. And financial stability had all been solved by the separation principle. And so maybe, some of the mission creep, I think, has come from the fact that certainly it was perceived that central bankers had quite a lot of competence and understanding about and analytical power to discover and uncover the trade-offs and make optimal choices, and that maybe politicians couldn't be trusted with this. I think I would want to step a little bit back from saying that we're talking a lot about uncertainty, but that's I think been there all along. The Brainard uncertainty I was talking about was not something. We've just highlighted the fact that there's an issue here, but that's something that analytically is timeless. So the fact that we can understand a little bit more and advance further, I think is a good thing. It gives us a bit more appreciation of the trade-offs that are eventually involved. But ultimately, the deciders in all this use an enormous amount of judgment. And I think that's a factor that's always underappreciated, that in this world of complexity, that's what we pay governors of central banks to do, is to absorb this meta issue of uncertainty and then to apply experience and judgment to try and see their way through. Now, whether as a consequence of all these things that we've been given, we've possibly overstepped what's healthy for one institution to have, I'd feel uncomfortable in opining definitively on this, but I can share some of your sentiment about where this has gone.
Thank you. I think I want to give the last word to Sandra, maybe also on the philosophical question on the breadth of the central bank's mandate, or what do you think on this?
Yeah, thank you. It's a good question. And so I was concerned with the minds, and one could ask, should central banks now take care of our minds as well? And the answer is yes. And it's a little bit different here, I think. There's an article from 2002, I think, by Frey and Stutzer, which was about happiness as an ultimate goal, perhaps. And so we should do nothing as economists without, losing sight of, what is maybe the purpose, basically. And here's similar. There's a direction of change, which is higher consciousness, more integration. And so we shouldn't, do anything which is kind of working against that, basically, against our minds. And the second answer I would give is that this is different also because once we take more care of our minds, this kind of alleviate trade-offs. So the trade-offs may possibly disappear. And that's kind of, almost magic, but this is what will happen. And so it's different. It's not producing more trade-offs, more difficulties, but it's actually alleviating that.
Thank you very much. So this concludes our session. Let me thank very warmly to our panelists for taking the time, for sharing your knowledge with us, for answering to the difficult questions, to all of you for your questions, for your interest. We're going to have a break of 15 minutes, and please be back at 4:15 for the high-level policy panel. Thank you.
Welcome back to this afternoon panel. Thanks for respecting this short break. I understand that after 4 power lectures, you wanted to have some respite, and the discussion there, it was quite tense. We are now in a policy panel, which tries to do a bit more, focused policy staging, which doesn't try to elaborate all of the details because it would take too long, but try to get a policy sense. And the background of this one is the whole conference is about is this increase in volatility. We heard very often the question about risks and how to deal with risk. In this policy session, we want to deal with 2 specific questions, which I immediately outline. Before I do that, I would like to see whether our virtual panel is also available. Yes, great, thanks a lot. Thank you, the virtual panel. And you see now the 3 panel members, the virtual ones, and the one who made all the efforts of being physically here. So let's start with him and give him a special applause. Philip Lane from the ECRB. Thank you for doing that, but I thought that's a panel we must have you here because it touches very much what your daily business is. And on the screen, we understand nowadays it's difficult to invest a full day in and out in order for 1.5 lectures, which is a full understanding. So let me greet in the order now of gender balance. Next one, Sarah Breeden. Thank you very much. Thanks for being available. She is from the Executive Director at the Bank of England and has a very impressive CV of things we're doing there at the level of at the level of economics, finance, but also gender, if I read your CV correctly. And then we have a little further out, we have Claudio Borio. Thanks a lot, Borio, for coming in. He's well known. He's the head of the Monetary Economic Department of the BS and also a SUERF fellow. And last but not least, my dear friend Tobias Adrian, Financial Counsel and Director of the Monetary and Capital Market Department of the National Monetary Fund. Thanks you, Adrian, also joining us. What are the two questions I thought we should address in this panel, which is linked with all what has been said before? And the first question, which should then be dealt with 3 minutes each by the panel before they enter in a discussion and before we move on to the second panel round and then open up to you to your question. The first question is a relatively simple one. The recent increase in volatility and risk has triggered the question whether we are still in an area of constrained manageable risk, which means that on the one hand we can do monetary policy independent of looking into the financial markets, because we have the separation principle that applies, which means that both have independent instruments and they don't have to look into each other particular monetary policy to keep an eye on the financial market. It can take care of its own. Or is this perhaps the case now, but are we moving towards a situation in which there are enhanced risk, where the developments of the financial market require us already to have a look at the financial markets, because we are not so free in setting the monetary instruments as we would like to have it. And this is something what we heard before, that we may be moving in such a direction. Or are you moving at the end of the day to a catastrophe again, in which we only have to look at the financial market stabilization, because if the financial market is not stabilized, we won't be able to do any monetary policy in any case. So this is the first set of questions which I'll ask the panel. And the panel will answer herewith the question is asked. And the second then is to say, okay, what are the kind of policy instruments what we have? And one of the policy instruments that came under major stress recently was developed over a decade now by Basel and had to do with the resolution framework. So a way, if a financial market institution, particularly a bank, gets into trouble, there's a way not only, how to say, to make it survive, but make it survive well, so that it becomes resolved, but stays at the market. It doesn't get into bankruptcy, and a lot of time has been spent in order to develop a resolution framework which makes this happen. And there have been good examples recently. One of the best we had in Austria was when the Sberbank was resolved in a way that doesn't exist anymore, but how to say, all the assets and liabilities has been resolved in a way which created an outcome which was pretty satisfactory. This is the second set of questions. As regards the first set of questions, I will now ask now our colleague from the BIS, Mr. Borio, to explain us how he sees the question about where we are with the risk. And he sent me slides or ideas. If we were to all talk about them, we would be here until 6 o'clock. So I will ask him to bring things together and put it in a level of 3 minutes to tell us how he sees about in what system we are and to what system we are moving. Are we in a separated system? Are we in a system which may be touched by financial market disequilibria? Or are we moving towards something which requires something to give financial market policies and solutions the priority? Claudio, the floor is yours.
Well, thank you. Thank you very much. So let me just give a 30,000 feet view of the type of policy challenges and risks that are out there, focusing on the financial sector in particular. And I think the place to start is to say that policymakers are facing an unprecedented set of challenges, at least by post-Second World War standards, which is the fact that they're facing recession risk in the context of a combination of a monetary policy tightening designed to bring inflation down and widespread financial vulnerabilities, high levels of debt, public-private, high asset prices, particularly real estate, and all after a very long period of risk-taking when interest rates were low, and unusually low for unusually long. Now, I say unprecedented because it's a kind of combination of two stylized types of recession risks that policymakers faced in the over that period. Until the mid-1980s, we faced what one might call inflation-reduced recessions, higher inflation, higher interest rates, economic downturn. But given that there was financial repression, global financial repression, there was very little action in the financial sector. Now, after the mid-1980s, leaving aside the COVID recession, we saw what I would call financial cycle-induced recessions. Low inflation, little need to raise interest rates, but then a big financial expansion turning into a contraction. And of course, the GFC is the most obvious example of that. And the big difference between the two periods was financial liberalization, which gave more scope for these financial expansions and contractions to take place. So, if you like, one could say that the macroeconomic background combines the worst of the two possible worlds, and there is little precedent to go by. And of course, the central bank's headroom, and this goes back to what you were saying, is more limited or more constrained than it was in the past, because financial stability interventions and the inflation, the need to bring inflation down, could pull in different directions. Now, I think it's important to say that the risks that we have seen so far essentially are the materialization of interest rate risk among NBFIs in the UK, the banks in the United States, and Credit Suisse. But I would say that the next inevitable stage is the materialization of credit risk, because financial cycles are turning, so that tough tests still lie ahead. And I think one should not fall prey of a kind of impatience illusion, because it takes a long time between the appearance of the first tremors, interpreted typically as liquidity risk, and the subsequent, typically larger ones that have to do with credit risk. So we're not really out of the woods yet. So against that background, a key question is how resilient the financial system is. And here, it's a tale of two stories, the banks and non-bank financial intermediaries. Now, we know that banks are in much better shape than they were before the great financial crisis, thanks to the financial reforms, much higher capital, much higher loss absorption capacity. And that's really essential to cope with any headwinds that will materialize. I think three considerations in that context. First of all, that given high debt levels, losses on exposure to firms are likely to be sizable. We do, in the annual economic report that will come out, we do some scenarios, and if market interest rates move along the market implied path, then losses would be roughly in line with historical experience. In a stress test scenario, say 200 basis points up relative to the market, they could actually be substantial, similar to those that we saw during the GFC. Indirect exposures with non-BFIs are hard to measure. And something else that we should look at carefully is the fact that many banks, many SIBs, many GSIBs, in fact, have price-to-book ratios that are languishing below 1, which suggests that there is quite a bit of skepticism about the valuations and the underlying profitability of those banks. So the bottom line here is that we are in better shape, but there is no room for complacency. Now, before banks got in trouble, all the attention was placed on non-bank financial intermediaries, and with good reason. We have seen quite a number of episodes of stress. I mean, the biggest one was the March 2020 turmoil, and those episodes of stress called for official intervention, central banks, and in some cases supported by the governments. Now, that sector has grown in leaps and bounds since the GFC, and although on balance is less leveraged than banks, there are vulnerabilities. First of all, there is a lot of hidden leverage and liquidity mismatches, which are highly opaque, and they're indirect, highly opaque bank exposures. There has been a lot of risk-taking during the low for long phase, so there is plenty of tinder to light the fire. And what was not intended and planned at the time when banking regulation was put in place, which actually helped this sector develop, is that there has been disappointing progress in developing a systemic-oriented prudential framework for non-bank financial intermediaries. And that's something that one should look at with urgency. So let me just mention a number of possible pressure points in this sector: private credit markets, commercial real estate, vulnerabilities in some government bond markets, and finally, I would say also vulnerabilities in the FX markets. And here I would draw your attention to the huge and hard to measure FX swap market, not so much as the origin of problems, I don't think that we'll see them there, but more like an amplifier of possible liquidity strains, particularly in US dollar funding. So let me stop there.
Thanks a lot, thank you. Would my characterization, putting together what you said, be correct? That to say we are at least between stage 1 and stage 2, and possibly stage 3 if we are not very careful. Would this be something which...
Stage 3, but clearly between stage 1 and stage 2.
2.
And stage 2 is going to tell us much more about the underlying resilience of the financial system.
Thanks a lot. Let me move on now to the UK, which is typically a sunny place where a lot of policy things has happened recently, which all move in the right direction. I'm sure you will somewhat open up and give a better presentation of the situation we're in. What is the UK assessment where we are? Stage 1, stage 2, never stage 3.
Thanks very much, and I'm sorry I can't be with you. I'd have loved to be in Vienna today. The short answer to the question is set out in the latest minutes of our Monetary Policy Committee, where we set out the view of both the MPC and the FPC, our Financial Stability Committee, our Financial Policy Committee, that we remain in a regime where the separation principle continues to apply. Those minutes make it clear that the FPC continues to judge that the UK banking system is resilient, maintaining robust capital and strong liquidity positions. And we know that the system is resilient to the current economic outlook and has the capacity to support the economy in a period of higher interest rates, even if economic conditions are worse than forecast. That judgment is based on the resilience that we've built up since 2008, as you've said, through a well-capitalized banking system with large liquid asset buffers, where banks have been regulated, supervised, and stress-tested on their resilience to interest rate risks and those broader credit stresses that Claudio just talked about. Now, of course, we have to monitor the lessons that we've learned from recent stress and the impact of higher interest rates on the global financial system more broadly. But from our perspective, we don't think we're in a world of uncontrolled financial stability risks or a world where financial stability concerns are providing a constraint on the monetary stability and the MPC's actions. It's worth stepping back and remembering that monetary policy and financial stability are at heart complementary, two sides of the same coin, if you like. Well-conducted monetary policy delivering price stability reduces the scale of economic fluctuations over time, and that reduces risks to financial stability. And of course, a more stable financial system reduces the extent to which economic shocks are exacerbated, which makes monetary policy easier. But the detail of how we go about achieving those two complementary aims is complex. In the UK, we've sought to manage it through two separate and focused committees with overlapping membership, and with these complex interactions managed through three things: shared analysis, policy action to build resilience in advance of potential stress, and targeted, differentiated market operations when those are needed. For example, the period of low rates, as we were just discussing after the GFC, was necessary to support the economy and for the MPC to meet its monetary policy objectives, but they, of course, created conditions that might matter for financial stability. The FPC was there to scan the horizon for risks and to take action to contain them, which we did through taking direct action to introduce limits on mortgage indebtedness, through stress testing major UK banks to higher interest rates, and through active use of the counter-cyclical capital buffer, that rainy day capital buffer that we raise as risks build, so that it can be released when risks crystallize, so that banks can absorb losses and continue to support lending to businesses and households. All of that built resilience in advance of stress, so that when it arose, the system was ready. Nonetheless, as you just mentioned, the episode of gilt market stress that we saw in autumn last year was a good reminder that we might not have got everything resilient in advance, and it proved to be a good test for our two committees. For those that aren't intimately aware of the details, what happened in that event was gilt prices fell after the UK government's mini budget, and some liability-driven investment funds found themselves over-leveraged, having to sell gilts into a falling market, creating a self-reinforcing spiral of asset sales and falling prices that risked causing financial instability. Now, of course, at that time, the monetary policy makers and the financial stability policy makers wanted to do different things. The MPC had announced its intention to start selling gilts, but to support market functioning and financial stability, the FPC wanted gilts to be purchased. I would argue that our institutional arrangements handled this tension well. The Bank of England intervened explicitly on financial stability grounds for the first time ever, with a targeted and temporary intervention, which we ended quickly after just 13 days. As a result, we were able to do what was needed for financial stability without treading on the toes of the monetary policy makers. And the goals of the policy were ultimately complementary: stabilising the market, supported financial stability, and supported the conditions for monetary policy to be carried out as normal. As we've seen more recently, tightening monetary policy after a long period of low rates has revealed financial vulnerabilities, and we need to remain vigilant and learn lessons. But here in the UK, the FPC have been clear that the banking system is resilient to the current outlook and has the capacities to support the economy. As Claudio said, let's hope that the non-bank financial system is in the same place too. I'll stop there.
Thanks a lot, Sarah. Thanks for your what expected optimistic outlook there. If I get you correctly, you are still in regime one, but how to say, you avoid too many things to avoid to move in the regime two, if I can summarize what you said. Now let's move on to the ECB. Where they think they are, where we are in this case. It's have to talk in plural. So, Phil, where are we? In what regime?
So let me come back to the separation principle and what does it mean? So for me, I think there's several different elements. One is that monetary policy remains focused on price stability. And I think the real way you can tell apart different regimes is if essentially monetary policy is redirected, you trade off a slower return to the inflation target for financial stability purposes. So I don't see that, we don't have that, and I'll come back to that. And then the second element, I think, of the separation principle, because it has to work both ways, is if there were a financial stability issue, could we solve it without derailing monetary policy? And I think both sides of that hold up. So on the latter, what we've said is indeed, if there were something going on in the European banking system, which we don't see for the reasons Sarah said for the UK, we have well-capitalized banks. We think the liquidity positions are good. But if we're going to do hypotheticals, in hypothetical scenarios, we do have our standing liquidity facilities, and ECB has a good track record of being able to provide liquidity when needed. And we do have a bank-based system, and that bank-based system, I think, matches well the capabilities of the ECB. So when I come back to the first part of that, the separation principle, I think it's... let me give it weak forms and strong forms. Weak form is basically that essentially we do have this, I think, underlying smooth adjustment. And look at all we've done in the last year and a half. In 2021, we bought over 1 trillion euro net of bonds. And then within a number of months, we stopped net purchasing, and now we're stopping reinvestment of the APP. So the withdrawal from the bond market has been pretty strong. During the pandemic, we injected a lot through the TLTRO program, which again is rolling off. We accelerated the roll-off, and there's a big roll-off coming now. And then we've raised rates quite a bit, all of which has been smoothly absorbed. So let me say 2 reasons why it's been smoothly absorbed, and why essentially everything we see tells us that monetary policy is working, the transmission is essentially predictable and effective. Number 1 is going back to Markus Brunnermeier earlier on, the markets essentially believe us. They believe that inflation will come back to 2% in a timely manner, not overnight, but within a foreseeable future. So I think that's very important. Monetary policy works, relies on this very strong anchor. And then second of all, and maybe, I don't know, I'm going to anticipate whether Tobias will be able to say something about this in a minute, is the underlying framework for financial markets remains the case that R star is low. That essentially once this inflation problem is solved, that for the next several years we will have interest rates that are cyclically high. But what the market is pricing is, again, if you move out several years, the policy rate will settle down around nominal 2. So we're not going back to nominal minus 0.5. And nominal 2, if inflation's around 2%, means a real rate of 0. So it's hard to create a lot of financial stability risks in a world of kind of essentially long-term low rates. So the underpinning for all of that is we get inflation down quickly. Because if we do not get inflation down quickly, then if we do have expectations de-anchored, then we're going to have a significant medium-term and long-term inflation risk premium, which we do not have now. So the world where we have nominal rates at 3 point something, and the market is saying, well, we're not maybe at the peak or near, but we're not that far away from the peak, is a world exclusively built on inflation coming down quickly. In a world where the market concludes inflation is not going to be defeated and it's going to settle down at 3% or 4%, that'll be priced into long rates. And if it's priced into long rates, we're in a very different situation. So for me, there's a fundamental here. This is my strong form of separation, which is basically the only way we have strong foundations for financial stability in the medium term is if we get inflation down reasonably quickly. Because what is basically keeping the market stable is that long rates remain low, because the inflation risk premium is not high, and also the real rate is modeled to be relatively low. So, I mean, there's uncertainty about the real rate, for sure, but in terms of inflation, I would say, again, my strong version is the separation principle, for it to be ongoing, we do have to get inflation down in a timely manner. So maybe I've drifted away a little bit, Robert, but let me finish there.
Thanks, Phil. Thanks also being very clear about where thinking is. If I got you correctly, it says separation principle is not something which is out the natural state. At the moment, it requires an effort to make sure that it happens, which means, that's my interpretation of your words, that we need to have well-determined future steps, if necessary, on the interest rate in order to re-earn the separation principle. Would it be roughly?
To maintain it, sure.
Yeah, exactly, to maintain it, okay. So, but still, stage one, regime one we are, but it needs to earn it. Now, let's move over to Adrian, who, what you have to say, are, together with a colleague, somewhat developed these three regimes, and which I borrowed from him, but I thought it's a nice way of framing it. And now the question to you is, I'm not so sure yet whether I ask you the state of the world, the different countries, or whether you answer my question with regard to the US, where your point is, it depends how to say what hat you have up there. But answer the question, how to say, in which way, how you see where the world is moving, and if you are allowed to do so, your assessment where the US is moving there, if you can do so. And as always, in your succinct way. The floor is yours, Adrian. Great to have you.
Thanks so much. It's wonderful to be back at Austrian National Bank, though I also regret not being there in person. My calendar is just so tight that I wasn't able to come, but I wish you a very happy birthday, so to say. So let me start off where we are now, and clearly the resilience of the global financial system has been severely tested since October last year. That's what Sarah alluded to, and market sentiment remains fragile. We have had quite a bit of volatility, and sort of like what is driving the volatility is shifting over time. But clearly, strains are evident across a number of institutions and markets, and that is also true across countries. Recent events continue to remind us of the challenges posed by the interaction between tighter monetary policy and tighter financial conditions on the one hand, and the buildup of vulnerabilities in the global financial system that were built during the time of low interest rates. We're fighting inflation, and that is more complex in the context of the recent banking pressures in the United States and Europe, as well as the non-banking pressures and the potential for more in both banks and non-banks. Partly as a result of this turmoil, bank lending conditions have continued to tighten, and loan officer surveys expect to continue to tighten further. But having said all that, we do not seem to be at a point where financial stability concerns would undermine the monetary policy objective right now. And I think our views here are very much aligned with what Phil and Sarah were outlining. Our baseline scenario remains one of a soft landing globally, and also in the US and Euro area for that matter. Of course, uncertainty is extremely high and risks are skewed to the downside, but the baseline is still one of a soft landing. So there's this narrow path that policymakers are on to restore price stability while avoiding a recession. And I think this is very much in line with what is priced into markets at the moment, right? When you look at market pricing, inflation does come down to target, actually more quickly implied by markets than what policymakers tend to think. And there's a slowdown of real activity, but it's not so like a sharp recession that is priced in at the moment, and that is also consistent with our forecast for both the US and the euro area at the moment. So with modest financial stresses, material trade-offs between price and financial stability objectives are unlikely. So in the baseline, we remain in what Robert alluded to, the state one. And in fact, the tightening of credit conditions that we're observing in both the US and euro area and in other countries around the world is part of the regular transmission of monetary policy, right? I mean, that is the bank lending channel that is necessary to transmit monetary policy to the real economy, to slow down aggregate demand, to get down inflation. So that is fully expected. And market-driven financial tightening can act as a substitute for higher policy rates, depending on how strong it is. And, many policymakers, particularly in the US, have pointed to the need to do less on the policy rate because this bank lending channel seems to have been separated. So this validity of the separation principle would, of course, need to be revisited if conditions were to deteriorate. So if some of the downside risks were to realize, there would be plenty of reasons to be concerned. And again, the likelihood of the downside risk, of the fatness of the tail is large. So given the current stickiness of core inflation, there is certainly upside risk to inflation. There's upside risk to further monetary tightening. And there could be more stress to the financial system. If financial strains were to intensify even more, threatening the health of the financial system, there could at some point be trade-offs of inflation and financial stability. Of course, central banks would aim to do everything to keep separation, i.e. to deploy all those crisis management tools to keep separation, but at some point that could become more difficult. So in the event of more stresses, that could potentially lead to a more systemic crisis. Central banks may need to not only provide additional, have to provide additional liquidity through asset purchases or standing facilities. And that could put pressure on the path of monetary policy. And that in itself could undermine the fight of higher inflation. So a deterioration of sharply deteriorating stress could end up in another systemic crisis. And here the tension between price stability and financial stability could become more acute. So again, the baseline is one to be in regime one where there's clear separation. In a second regime, which we don't think we have entered to in the major economies, there could be some interaction, but then the real systemic crisis, of course, things would be slightly different. Now, I do want to finish by pointing out that there are, of course, macroprudential tools as well. And, to continue to build buffers seems very important. I think bank supervision and policymakers with macroprudential objectives are working on that, particularly in Europe and I think in the UK as well. So I think it's still we're still at the point where building buffers actually makes sense. So let me stop here. So just to get to Philip's point, I fully agree with Phil's suggestion that interest rates are likely to return to a relatively low level. So we had a chapter here at the IMF on where our star is, and that is very closely aligned to where the market is pricing our star, and that is one where interest rates are indeed coming back down to lower levels. So, our star in the US is slightly higher than in the euro area, but it does return to fairly low levels. But of course, the main risk factor is the persistence of core inflation, right? So headline inflation is coming down, but core inflation, is stabilizing in the US and perhaps coming down slightly in the US, but in the euro area, we are not at that point yet. And there's certainly some upside risk to core inflation, and that in turn also triggers some of the downside risks to financial stability.
Thanks a lot, Adrian. I think you summarized well that at the moment your baseline is still regime one or plan number one, but there are risks out there which may lead to that one has to pay attention what happens in the financial sector. On one thing you raised, I would like to get a clarification from you and perhaps from others. You said, okay, we have seen already that monetary policy increase in interest rate, has reduced the lending in the private sector. So this needs to be, taken into account when the interest rates are set. Isn't it a little bit of double counting? Because if the money transmission mechanism works as envisaged, then the interest rate what had in mind, or it takes account into this element. You do it especially because you think it's happening there. I'm just asking because it has happened also in other quarters. My sense is it's double counting. If you would have to have special effects there, otherwise it's a normal effect. Raise interest rate and the banks reduce their loans towards the private and public sector. This is the part of the game. Just think about it. I had envisaged that we have a little exchange between the group here now. I didn't sense too much difference there, except there's always very visionary view of Claudio, who said there are many things which can go wrong. Is there something which you would like to add, subtract, or add to that? There's no need. Phil, do you want to say something?
I mean, basically the historical narrative of the last 40 years, I think Claudio captures it. So we did still have elements of financial repression even earlier. So I fully agree. And the basic narrative, we did have these big financial cycles, and super costly in the euro area. I mean, it was really costly, those twin crises, the bubbles in the periphery of Europe, and so on. Very, very costly. But it's also the case, again, if we jump forward 20 years and look back at this time, one of the open questions is how much the policy response after the crisis has basically will prove to have moderated this to a fair extent. So we do have across Europe now macroprudential policy. Now it differs across countries, but in terms of the amount of leverage in households is a lot less than it was in many countries because of mortgage rules, essentially, loan-to-value ratios, debt-to-income ratios, and so on. We do have much higher capital ratios on banks. One of the big, I think, kind of links between time periods is the amount of risk aversion. And again, maybe in the spirit, even though it's a bit awkward when some of us are on screen and some are not, but maybe especially to those on screen going back, which is for me, throughout the last decade, there's been in the euro area, but maybe it's not true in the US or globally, there are pockets where people did really respond to the narrative of very low rates for long, indefinitely, and the risk of that this would lead to a lot of risk-taking, repricing, and so on. But it's also the case, so many parts of Europe were deleveraging, were recovering from the crisis, that I do wonder whether the amount of risk-taking was so uniformly high in the euro area. Claudia, you mentioned that there was a lot of risk-taking with low for long. And directionally, yes. But it's also the case, I mean, I think a lot of us, you know, we're basically saying, where is it showing up? And then with the macro proof for non-banks, which I fully agree with, I mean, I think we should have done it and should be doing it. Reducing leverage, improving liquidity in non-banks, I think it is a natural instrument which we should deploy, and it's doable. It's this idea that it's not doable, I don't think so. But going back to one thing that Markus Brunnermeier said earlier on about diversification, it is the case, I think, the fact we now have a more diversified financial system in Europe, that the absorbers of interest rate risk, the absorbers of commercial real estate risk, and so it's much more diversified. It's, you know, compared to what we had before, maybe we will have some nasty surprises, but I think it has to be the case that the more you've got a bigger role for non-banks compared to where we were. For me, the dominant issue there is the risk is being spread out. There's a lot of global ownership of risk in Europe. It's not just contained in the euro area. That's a big question, is how much, and some of the BIS data does help to process risk transfer and where the ultimate risk is being held. So I do think when we think through a lot of these issues, we do also have to recognize the policy environment now is different. I think it's a lot better to have ex-ante insulation against risk rather than ex-post rescue missions or whatever. And of course, time will tell, but I just thought I'd raise some of those issues.
Okay, thanks. This was a great transition to the second question, which, to recall, is it in order to make the separation principles work, is the financial market stable? Are there instruments which have been developed over the last years, ever since the great financial crisis, through the Basel Committee, are they working? And one of the things is that they are working, otherwise separation principle cannot work. And this implies inter alia that we have a resolution framework which allows a handling of small, large and big banks in a way that resolution takes place that does not impact the financial market system, in the sense that liquidity dries up and the central banks have to come to the table. It does not imply that there are no bankruptcy taking place on a resolution. For this there are, but the system is stable. Now we have seen that in US problems there. We have seen Credit Suisse there. Now the question is, were this simply examples which prove that the system is working, or do we have to worry that the resolution framework is not as firm as we would have imagined? Most importantly, we still have out banks that are big to fail, perhaps also too big to save. Is this the case, or can we sleep well? This was only, how to say, an exception. For the rest, the system works, and hence separation works. And for this, I will give the floor now, the first one, to Sarah, because you haven't had yet a bank run, but so I'm sure you have a full grasp of what happens with the resolution framework, and it would work in case it were to be demanded to be invoked in the UK, correct?
So we did have a bank run because Silicon Valley Bank had a UK subsidiary which lost a third of its deposits in 24 hours. The one thing that I wanted to emphasize, though, is that the resolution of that UK entity, Silicon Valley Bank's UK subsidiary, was a success as we see it, with our resolution regime working as intended. And the second thing I wanted to say was that we welcome the comprehensive set of actions taken by global authorities to support financial stability in the resolution of their entities. But in the UK, what the resolution of SVB in the UK showed was that the bank, the PRA as the supervisor, and UK authorities more generally it demonstrated that we put in place practical arrangements to support a rapid response and successfully deliver a resolution where the entity was sold over the weekend to HSBC for £1. There'd been extensive preparatory work with UK authorities more broadly on the regime, and that stood us in good stead and helped us effect that successful resolution. The regime worked as it should. However, we can't be complacent. We need to learn lessons from experience more broadly, whilst remembering, of course, that every resolution is different. We are, as others are, undertaking a lessons learned exercise, and many of those issues we'll want to take forward in international fora. But I wanted to highlight two in the discussion today. Firstly, the importance of a robust prudential and resolution regime, including for smaller firms. And secondly, the speed of runs and what does that mean for the regime as we look ahead. The SVB episode highlighted the importance of maintaining those enhanced standards that we brought in after the global financial crisis. It was the implementation of those robust standards on capital and liquidity that enabled us to be able to sell the bank over that weekend. And so the resolution and prudential regime has enhanced our ability to mitigate shocks. What we need to do is make sure that robust regulation and supervision of liquidity and funding and of capital are maintained, and also that we supervise, including good risk management. As part of the Strong and Simple initiative in the UK, we're currently developing a prudential framework available to small domestic firms which are not internationally active and which have simpler business models. What we've learned is that as we design that framework, we need to focus on that first S, strong. Simplifying should not be associated with a weakening of prudential standards. And more broadly, I wonder whether we should ask ourselves whether the calibration of the Basel regime as applying only to internationally active banks is the right place to have a cut-off. What we also saw was the speed of deposit flight in a world of digital payments being much faster than we have ever seen before. We had discussed the idea of a catastrophic bank run in the context of the possible introduction of a central bank digital currency. It turns out that we're living with that risk courtesy of digital payments anyway. We also discovered that social media can increase the likelihood of many depositors running at once, whether for warranted reasons or not. And of course, correlations matter for financial stability. To my mind, that raises two questions. Firstly, do we need to adjust the outflow assumptions in liquidity regulations? And if we do, what does that mean for fractional banking and the provision of credit? There's potentially some really big macro-prudential issues there. And then secondly, what does all this mean for our deposit guarantee schemes? Two aspects of that. Continuity obviously really matters. Concerns about continuity can create the incentive to run. In the UK, payout for depositors is after 7 days. Is that fast enough in today's world? And then secondly, who should be insured? The focus to date has been on retail and SME, small corporates. But maybe we need to be thinking about corporates more broadly, given their need to pay wages and the like. Underlying all of that is that a reminder that financial stability authorities need to focus on liabilities as well as assets. There's certainly a lot of reflecting for us to do. Maybe I'll stop there.
I mean, you mentioned a point, I think, which came to all of our mind when this all happened with Silicon Valley Bank, is the question of the speed of outflows. And I think a solution has to be found there. But you also mentioned the question of the assets, because this also happened, you know, you have to measure the asset value correctly, and this applies that you also have to take account future monetary policy and interest rates, which change the landscape as it has happened there. May I move now over again to Claudia, to the question of, okay, how you see it in your conceptualized way, the resolution framework. Is it working? Can it be made working? And if you have, I mean, you lived close by physically, and I'm sure also emotionally, what happened at the Credit Suisse. Can we ever really believe that a bank of this size, so to say, can be resolved with all the intricacies involved? Or will we always need the central bank and perhaps the government or both, as we had seen, to solve it, because they're simply too big?
Well, thank you. If I may, I'd like to go back to the bigger picture for a second, given what we heard. Let me say that I find I don't think that putting forward the debate in terms of is there a separation principle, is there not a separation principle, is particularly helpful. We have a task, which is to bring inflation down. We have to bring inflation down, and we have to deal with any financial stability problems that take place. If those problems are mild, then there is not really much discussion to be had. If those problems are more serious, they will still have to be dealt with. But they will have to be dealt in a way in which we will be succeeding in getting inflation down, because otherwise the costs longer term, including for financial stability, are going to be higher. And we have to do it in a way in which we deal with stress. Now, if stress is very contained, no big issue. If the stress is more widespread, then clearly it's not something that can be dealt with by the central bank alone, by providing liquidity, by buying assets. We have seen that even in cases in which, say, take March 2020, there are actions that the central banks can take only with the support of fiscal authorities, because they have to provide the necessary fiscal backing in the form of guarantees and the like. So the tools are there, and I think they will have to be used. Now, resolution schemes are part of this bigger picture. Are they perfect? Definitely not. Are we in a better position than we were before this very ambitious agenda was put in place? Yes. Have debtors, even in the case of Credit Suisse, taken losses? Yes, which is something that did not occur before. But again, at the end of the day, if the problems are, if the system, if there is a loss of confidence in the system, there will need to be broader actions on the part of central banks, on the part of prudential authorities, and also on the part of government. So I would just focus on that. I would also add, again, in terms of the bigger picture, that so far we have talked a lot about monetary policy. We have also talked, and rightly so, about prudential policy, both in terms of microprudential and macroprudential. I would have added to what we've heard so far, although it was mentioned in passing, that something that can be activated, it can be made more stringent immediately, is supervision. And I think that we need to use that tool, quite apart from the longer term lessons that we will have to take into account, draw from this episode in terms of regulation and supervision. But I think what we should bear in mind is that as part of this broad package to deal both with inflation and with financial stability, the government, fiscal authorities, there is a lot that they can and should do. not just in terms of providing support in case problems occur, but also in terms of helping in the fight against inflation. And that, from that perspective, I think that's something that we should focus on, is the need for fiscal consolidation. Fiscal consolidation, which will help reduce inflation by putting less pressure on productive capacity, and which will also, importantly, therefore, reduce the need for central banks to raise interest rates or to keep them higher for longer, therefore reducing also the financial stability risks that we're facing. So the bottom line that I would like to stress, yes, there are issues about resolution. Yes, there are broader issues about, if you like, deposit insurance, which I think would deserve a discussion of their own. But we need to think of a holistic approach to the problems that we're facing now, in which all policies, monetary policy, fiscal policy, prudential policy, and crisis management, in which the various authorities are going to be involved, have to play a role.
Thank you, Claudia. I appreciate almost your big picture. I'm somebody who also likes to look into some of the issues there. And what I see that one of the assumptions you make is that the resolution or the financial market stability framework is working. This is a great assumption, and the question was, if and as it doesn't work yet, it has an impact for me on monetary policy, because we have to take this into account.
I think there is another question about the resolution framework that has been put in place, which I think is better than what we didn't have before. And of course, it can be improved and it should be improved. But the broader question is, how can you stabilize the financial system if problems arise? And that is not just a question of how you resolve individual institutions. It is a broader question of how the central bank, the fiscal authorities, the prudential and resolution authorities work together in order to deal with it. And I mean, and it's easy to see that that is the case just by looking at historical episodes.
I have no issue with your last question assumption. Let's move on. Adrian, you are also engaged in these discussions about to what extent the financial stability is reigning, how can it improve. Claudio designed the big picture that all things needs to work together, including fiscal policy and the rest of it. But if you look specifically at the questioners, is your view that with regard to resolution, you saw it in the US now, is it simply a minor accident that happened, or is there something which is more deeply, which requires a review, or at least the extension of the Basel framework to all banks in the US, including the different stress tests, liquidity tests, and others?
Yeah, thanks so much. Let me start by just agreeing with Claudio on the need to look at the fiscal side as well. We have been outspoken many times that monetary fiscal interactions are very crucial in the fight to get inflation down. And of course, for resolution, resolution only works if there's a fiscal backstop. So turning perhaps to SVB and the US case first, and then to Credit Suisse second. I would start by noting that we have been through a series of extraordinary shocks, right? Starting with COVID, and then the Ukraine war, the run-up of inflation and commodity prices, and now interest rates that are significantly higher. One of the early lessons from the SVB crisis is that there is a weak tail of banks in many countries. And in a situation where there's heightened financial stability or financial instability that is triggered by the slowing of economic activity and the high interest rates, these weak banks can have spillbacks into the broader system. We saw that clearly when SVB went into distress. The regional banks in the US were under pressure, but also banking indices more broadly were significantly repriced, both in the US and in the euro area. Some of that has reverted, but by far not all the way. So, you know, concerning SVB, I think it needs to be recognized first that there's a deep management failure at the root of the SVB failure, right? This has been well documented. There was no risk manager. There were interest rate hedges that were taken off prematurely. You know, the massive size of deposit inflows was not managed adequately. The second failure, I would argue, was one of market discipline, right? I mean, in the Basel framework, we have the three pillars: regulation, supervision, and market discipline. And clearly, SVB had some of the most sophisticated investors, you know, at all levels of the liability side, and they did not exert sort of like the pressures that we would expect from market discipline, right? I mean, you know, the risk of deposit outflows didn't discipline management. And that's a recurring story in many instances. So then there's the additional burden on supervision and regulation. And, you know, we had the 2020 FSUP in the US, where we clearly flagged that the kind of regulatory tailoring of capital and liquidity regulations, as well as supervisory standards, was problematic and dangerous. And the kind of recommendations that were made at that time are very well aligned with the recommendations that the US authorities now, after the failure of SVB, came forward with. So the Fed, the FDIC, and the GAO all outlined a range of weaknesses, including in supervision and regulation, that we fully share. And you know, let me finish up with Credit Suisse briefly. So I do also agree that, you know, Credit Suisse was not resolved, right? So this was a merger that was supported by the government through both liquidity and credit backstops. But the spirit of this merger was, in our view, closely aligned with the resolution framework. I would have personally rather seen the bank going into resolution and then conducting this merger and resolution. That would have meant that the equity would have been fully written down. It was not fully written down, but it was nearly fully written down, and debt was bailed in, the AT1s. So the outcome did preserve financial stability. It looked very different from the government support of UBS in the global financial crisis, right? At that time, the Swiss government injected equity and only diluted the shareholders and set up a special purpose vehicle to move toxic assets in. So there was the Credit Suisse merger was very, very different in philosophy from this UBS support over 10 years ago at this point. But you know, there's clearly this debate about whether the resolution regime could have been used. I think it could have been used. I think the Swiss government felt that it would instill more confidence not to use the resolution regime, but of course we will never know the counterfactual on this point, unfortunately. I think the main difference would have been writing down equity entirely. It was nearly entirely written down. There were 3 billion left, but the AT1s would have been bailed in as well. And there could have been, any government support in forms of liquidity credit guarantees there as well. So in sum, I do think that the resolution framework has moved a very, very long way. We will, the regulatory community will certainly look very deeply into whether there are further twists that need to be made. I do think we have moved in the right direction. Now, having said that, of course, something that nobody has mentioned to date today, at least not in this panel, is the one massive risk that is hanging over us, that is a tail risk, that could have, quite dramatic implications, and that is, of course, the debt negotiations in the US. Hopefully that will be resolved, but of course that could have, an impact on financial stability, on financial conditions that could be very global in nature.
Okay, thanks for reminding us that the Security Swiss was not a resolution. The question is, was it a shotgun marriage or endowment marriage with government support for 100 billion? I think to say it was successful, but not priceless. Let me move on now. The last speaker on this topic, Phil, to say you're sitting in a comfortable position in Frankfurt. We all agreed that our financial market works and also the regulatory framework works. So you can focus only on monetary policy because whatever happened outside won't happen in Europe.
So I mean, I think we had this theme earlier on, is that I think is broadly true, conditional on us maintaining our policies. And so, for example, in March, I think there was a general accept. It's very important for the Eurosystem and the European authorities more generally to be super clear very quickly about the strength of the European financial system, and also the specific nature, for example, of how AT1 are treated in the European system compared to the particular way Switzerland had set up the AT1s. So it's important, I think, going over and just reinforcing some of the messages here, is compared to what we had before, it's only good, it's a positive to have the single resolution mechanism, the single resolution board, to have resolution plans, to have national resolution authorities. That whole infrastructure is only beneficial. Resolutions should be rare events, so it's not the case. I mean, and we've talked here about the US and Swiss experience, and of course regulators around the world and resolution authorities around the world need to draw what lessons they can. But in the end, I mean, I think the focus should be on the toolkit. We have a toolkit where resolution is part of that. And again, I think as Tobias basically made this point, which is even when you have an episode where resolution is not formally used, a lot of what that infrastructure has been set up for can be used. And that's really the bottom line here, is compared to the naivety and uncertainty that was there in the global financial crisis, and all the history of that period was there's naivety and uncertainty. There's a lot more structure now, I think, what can help. But as Sarah said, I mean, it's also the case, the word is speeding up. I mean, the speed of the electronic runs and so on do mean that we should not be complacent. In the European context, it does, I think, reawaken some of the files which have been maybe a bit slow-moving in recent years, crisis management, capital markets union, European deposit insurance. All of these, everyone understands that these are important files to move along, and I do think these concrete episodes make sense here. Maybe I'll come back, Robert, at the start you did say, in passing you were responding to, is a tightening of credit just normal transmission, or is it something else? Maybe I will make 2 points from the European point of view, and whether there's also points you made elsewhere. One is, of course, what we're focused on is our credit conditions tightening in a surprising way. And the most recent bank lending survey was surprising. So compared to various metrics, including what the banks themselves said, it was surprising. So number one, surprises are informative. Number two, and this is maybe not a fundamental issue, but depending on how you set up your economic analysis, you know, we do think at the ECB that monetary policy works not just through the price effect, not just through observed lending rates and so on. It also works through, if you like, a credit quantity channel, terms and conditions and so on. And what we've been, you know, I've given repeated speeches in the last year, is part of our strategy review, I think, as well, is we run a range of models. We don't have all that many tightening episodes. We do have uncertainty about whether the transmission mechanism is very strong or milder. And these pieces of information, I mean, I hope it's not, there's no double counting going on, but we do have to make choices about, do we put more weight on the models where monetary policy is more powerful, or do we put more weight on models where it has a more limited effect? And so these data help to kind of inform us to some extent on those issues. And of course, in our criteria for monetary policy, what we learn about the strength of monetary transmission is one of the criteria for the reasons that Tobias said, which is basically, you know, for a given policy rate, the overall impact on financing conditions, which ultimately the overall impact on domestic demand and therefore on inflationary pressure does depend on how the financial system is responding. Whether it's responding to the policy hiking or global factors is secondary. It's essentially the tightening in the finance conditions is really what's going to matter.
Okay, thanks for this clarification. We have now a quarter of an hour left. There's on purpose to give you also towards the end when you listen too much, your possibility to ask questions. I tried with my questions to lead the provocation, but I do hope you can exceed me, please.
First, a very quick question.
Your name, please, affiliation, and to whom the question is directed, please.
John Danielson, London School of Economics, to Philip first, and then quick to Sarah. Philip, in the United States, a significant problem with quantitative easing is that it ended up as demand deposits and then ended up as reserves, both a significant part of bank profits and a significant contributor to systemic risk, and the US authorities find it difficult to cope with this. Is there anything similar at work in Europe? And to Sarah, a quick question. I'm very much heartened by your optimism, but I'm also struck by the contrast with the chief economist of the Bank of England that said a couple of weeks ago, we're all getting poorer, we haven't tightened the belt. Can you reconcile your optimism with his pessimism?
Thank you. Question up here, yes, thank you.
Yeah, thank you very much, Per Siegenthaler, Rocco's Capital. Also two questions. One, maybe for Tobias and maybe for Claudio as well, in terms of the monetary transmission and specifically maybe the US, as far as you can comment on that, how much do you think, Philip just mentioned that there was a surprise in the bank lending survey in Europe. Are you seeing the rate hikes being transmitted to the system, and how much have you been surprised by the reaction in the banking system? How much do you think there is a non-linear, or has been non-linear reaction, and maybe is a risk of further? So obviously the market is very concerned about further credit tightening there. And to Philip, in terms of the core inflation, I mean, we are in a country in Austria here where somebody just told me in the break that there is a wage price spiral going on. I know that's not the case in the broader euro system, but still core inflation remains high in the euro area. So how confident are you, or what kind of signs do you see that makes you more confident that we are on a good way there? Thank you.
One last question up at the lady at the end, is it? Exactly, and then we close the list. Thank you.
We have a question in the chat.
Yes, please. Let's start with the chat question.
From Muhammad Hasnain Yousaf. I don't have an affiliation here. Regulators over the world have continued to resort to mergers instead of letting the problem banks fail, citing various reasons. However, more often while these problem banks go, but their induced problems don't, just like we're seeing recently with the UBS Credit Suisse saga, don't you think that the regulators need to be a bit brave instead of finding quick fixes?
Okay, was the question directed to anybody specific or general one? Okay, general. So everybody who has time is invited to do so. We have 10 minutes left before people, so 2.5 minutes per person, please. Philip, you're renowned for your short answers, 2.5 minutes.
Okay, thank you. So on John's question, so definitely the two big programs by which we expanded the balance sheet, which is bond purchasing and then targeted lending, they work on both sides. So a lot of time we focus on, if we buy a lot of bonds, does it push down term premia? If we have targeted lending, do we convince the banks or persuade the banks to maintain credit during the pandemic? But there's also a liability side to that, which is basically on the liability side, we issue a lot of reserves. And then the question is this, how does this excess liquidity affect behavior, not just in the banking system, but in the wider financial system? This is something which is also true in the US, I'm sure in the UK debate as well. Now, the question, we can see it in the sense of conceptually, we can see that one of the big questions is, now there's been a move. The balance sheet is moving quite quickly, and what's fair to say is faster than was expected in, say, in December 21. Is it the case that kind of decline in liquidity will reveal that some banks may have encumbered their liquidity through credit lines, issuance, and other ways that liquidity may have influenced decisions? And equally for non-banks, if they made decisions on the basis that if they needed to, they could turn to banks for liquidity on an open-ended basis, and that is no longer true. I can see that these are factors, but we haven't seen anything yet. But of course, monetary policy works with a lag. I would say in our bank lending survey, the banks are telling us one reason they're tightening credit is because of quantitative tightening and the roll-off of TLTRO. So they are directly saying to themselves, it's not just a response to higher policy rates, it is a response to a shrinking balance sheet. But it will be something that we definitely have to pay attention to. So I would classify that as one of the policy uncertainties we need to look at. Another type of policy uncertainty is the exact degree of intrinsic persistence in the inflation process. So Beat was asking about this. First of all, I mean, it's fully baked into the analysis. All of the models the ECB run have a lot of persistence in there. It has to be the case if prices rise in 2022, it puts upward pressure on wages and other prices in 2023, etc. So we have a lot of, and in some of my recent presentations, you can see the graphs, very strong nominal wage increases, not just this year, but again in 24, again in 25. Austria is at the upper end, so we focus on the European average. And so essentially, how do we reconcile this with inflation coming back to 2%? It's basically, that is going on. On the other hand, we have the easing of bottlenecks, we have the normalization of the services sector after the pandemic, we have the reversal of energy prices, which over time will drive down core as well. I mean, there's a pretty strong leading indicator property. If the overall price level comes down, there's less pressure on wages, less pressure on core. So the forecasts already in March already had basically simultaneously a lot of upward pressure on services inflation, but still in a way that leads to a route back to 2%. But we do list it as an upside risk. There is a call that's been made in the forecast about the degree of persistence. One of the stable upside risks we have is if wages respond more quickly than that. So it's definitely one reason why we do have this data-driven approach, including looking at underlying inflation. And maybe my last point here is essentially For me, I try and step away from core inflation as a category because the dynamics of goods inflation, where there's a big traded component, will probably be different to the dynamics of services inflation. And so I would step away from overly focusing on core and look individually, step by step, about services inflation and goods inflation.
Thank you very much. Thank you. Sorry, I didn't want to interrupt you, but make some noises in order to get things straight. Let me move on now to Claudio for answering the question was directed to him. Thank you.
Well, I think most of the questions were not directed to me. But what I could say are a couple of things, and then I'll leave it to Tobias to be more concrete, perhaps. But when it comes to the transmission mechanism, in terms of financial conditions and the like, I mean, non-linearities are of the essence. That's effectively how the mechanism works. The only question is when those linearities kick in, and that has clearly to do simply with the nature of debt, with the nature of bankruptcy constraints, and so on. On the issue of effectively, there was a question that was again about too big to fail. I don't think that there is much more than I can add to what I mentioned earlier, which is basically that we are in a better position than the one that we were before the GFC. The resolution frameworks are not perfect. I think we need to be realistic, but they have definitely helped under current conditions. Even, again, let me just stress, even in the context of Credit Suisse, as was also remarked by Tobias, there was, creditors were written down. So it was not a sort of a merger, and equity was also, not completely, but it was also written down. So it was not just a free lunch for those involved.
Thank you for the brevity as well. Adrian, may I ask you also for your 2 minutes?
Yeah, so on the resolution question, so SVB and Signature Bank were put in the receivership. So debt and equity was completely written down, and then the assets were sold off, and or whatever franchise there was being sold off. So this is, totally by the book. Credit Suisse, as I said, they could have done even a merger in resolution, and that would have been fully consistent with the FSB's principles. It's hard to second guess why that wasn't done. A liquidation would have involved, also writing down the other debt, right? So Credit Suisse had an enormous amount of other debt, so it would have ended up with an enormous amount of capital as a result if it had been liquidated. But it's very hard to say whether that would have been better for financial stability or so. Again, I mean, there was some amount of government support, but it was, small relative to what we saw in the GFC. In terms of monetary policy transmission, I fully concur that it's all about nonlinearities. We have seen a certain amount of nonlinearity, but there's a potential for much more. One thing I want to point to is the runoff of deposits into money market funds. So that is much more relevant in economies where the market-based financial system is more developed, such as the US and the UK. And in the US, I just want to flag that since the start of monetary tightening, since the interest rates have come up, the overnight reverse repo facility, which is essentially a way for money market funds to hold reserves with the Fed, has gone from about 100 billion to about 2.5 trillion. So 2.5 trillion is about 50% of money market fund assets. So money market funds in the US have $5 trillion. Total deposits are about $17 trillion. So, it's quantitatively large. And about half of those money market fund assets are directly with the Fed. So they are compensated at the lower band of the policy rate, right? At the market rate. What I want to point out to finish is that despite that, retail deposit rates have barely budged up, okay? So even though there is runoff of deposits, partly to big banks, from smaller banks, partly to money market funds, that has not, put, a lot of urgency on the retail deposit rates to be raised.
Yes, this was a very important comment, because we often dream that if and as we would have money market funds, we would create competition to the banks. Apparently, this may not be the case. Thanks a lot for that. Let me end up with Sarah. Sarah, we have the last minute of fame, please.
Thanks very much. Two really quick things. On, are we being brave enough? The losses have to go somewhere. It's creditors, it's depositors, it's the rest of the banking system, or it's government. I think we've seen a big change with creditors taking losses and governments not. Obviously, we've learned there's a bit more to do on our attitude to imposing losses on depositors. And to John's question about how do we square mine and Hugh Pill's prisms on developments in the UK, I think it reflects our different roles. Hugh as a monetary policy maker, mine as a financial stability policy maker. Hugh's talking about the enormous terms of trade shock that our economy is undergoing and the hit to real incomes that we have seen. I'm optimistic because I have been confident that the financial system can absorb the shock that that creates, keeping us the right side of the non-linearities that have been a theme of our debate today.
Note on which you ended. This allows us from here, and I mentioned to you, since you are not here, to go to a cocktail, which you're unfortunately going to miss. But I hope all of you will one time or other come back to Vienna, in particular as of hopefully next year we will have our big hall renovated in imperial splendor, and hope I can welcome you there. So thank you very much for your time, for your inputs, Tobias, Claudio, Sarah, and Philip here. And let's give them a round of applause. Thank you. Thank you. The meeting is adjourned. Thank you.